look at the bigger picture, the broader trends in inflation and core are moving down.
Most people are not anticipating a re-hiking cycle or a re-acceleration in inflation.
Ultimately, after what we went through, I'm just happy that tightening's over.
There's plenty of time to see how the balance between growth and inflation plays out.
The economy is on a cooling path, but it's a very gradual path. There have been a lot of tailwinds for the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market on the S&P 500 positive by a third of 1% in yesterday's session, pulling back from all-time highs just a touch. A fairly quiet state of affairs over the last 24 hours. That picks up in about 2 hours and 30 minutes time. Get a ton of economic data, retail sales, PPI, Lisa, jobless claims just around the corner.
It's the last inflation read before next week's Fed meeting. And to me, this is the key point. Do we get a confirmation of what we saw from CPI? And if so, do markets care? Because so far, it hasn't seemed like anyone's been particularly fussed about the fact that inflation keeps coming in hot and the Fed is still going to cut rates. That's the belief right now.
That disinflationary spell, if we can call it that, over the last 6 months feels a little dazed and confused at the moment. Citi's Andrew Hollenhorst, and we talked about this note yesterday, he called it the last mile problem. How big is that last mile problem?
Well, it remains to be seen, but PPI will give us a little bit more hints of what's going on. Also, retail sales. What is going on with the consumer? I look back into the reports that happened in January, the earnings report, Walmart's CFO. They're being choiceful. They say consumers are still coming into the store. They're shopping frequently, but they're trying to be choiceful on what they're buying. Is that going to see a softer retail sales? Is that going to maybe potentially put a little bit of a dent of this resilience we've seen in the American consumer?
Well, speaking of what's going on with the consumer, look at the estimate for jobless claims. If jobless claims is anything to go by, nothing's going on with the US consumer. The US consumer is totally fine. 218 is the estimate for jobless claims today. Last week, 217.
Yeah, the whole thing about it's noisy and there aren't enough people reporting to the surveys doesn't really work because it's this way every single week. So then it raises this question, what do we have to reassess in terms of where we are? Jenny Yellen yesterday was talking about how she actually was wrong with respect to what the rate was post-pandemic, that she does think that it's going to be higher. And that, to me, really indicates that people are reassessing what this means and how hot this economy really could run.
You took us down to Washington to talk about Secretary Yellen. Let's talk about what happened through the House. TikTok bill breezes through the House. Then senators start to line up just to say, slow down. We take our time here in the Senate. This could drag on and on and on.
It absolutely can. And then you look at some of these hawks, usually on foreign policy, like Lindsey Graham. He was on Fox last night, and he said, well, it's a good question when he was asked about how he's going to vote. And he said, I'm leaning yes, but his concern is, and he's kind of coming in line where the former president is, so potentially that's why he feels this way. He's concerned about if TikTok's not there, where do those individuals go? And it's the Facebook Meta play. It's the potential of Google, X, Twitter. But the bottom line is, and I was pretty astonished to see yesterday the bipartisan support, one, for it passing, but also the bipartisan support of the noes. Marjorie Taylor Greene lining up with Alexandria Ocasio-Cortez. It's not every day you see this in Washington.
Well, but isn't that the way it always works, that the polls kind of come together? And that's sort of where we're at right now. I am curious about this pushback because of the political affiliation of the potential buyer. The fact that you want a conservative buyer to come in and take over TikTok's operations. Are we going to have hearings to sort of, justify someone's credibility on one side of the aisle or the other before they can take over this because you want to prevent it from the liberal social media companies of Meta taking over? I mean, really, where is this going?
I found the whole episode very entertaining, particularly hearing what China's got to say about the whole thing.
That was hilarious.
The reaction from the counterfeit capital of the world. This quote right here, when someone sees a good thing another person has and tries to take it for themselves, this is entirely the logic of a bandit. Can I share with you a report that came from Catherine Tai in the last year or so? WeChat, China's most popular chat app, one of the largest platforms for counterfeit goods. Counterfeit and pirated goods from China, together with transshipped goods from China to Hong Kong, accounted for 75% of the value of counterfeit and pirated goods seized by US Customs and Border Protection. So to hear China talk about bandits and stealing other people's things when the stats sort of say something else about what happens in the mainland is rather entertaining.
It's also pretty rich that they're saying the U.S. should respect the market economy and principle of fair competition. To that point, let's think about this for a second. That's all I could say.
Well, also, what American social media company is actually being able to be successful in China, None of them. So it's just a little bit funny. Also, the TikTok version in China, very different on how they allow children to engage on that platform than it is in the United States.
More on that story in just a moment. Let's start with the price action this morning. Busy day ahead with tons of economic data. Equity futures on the S&P 500 firmer here by 0.33%. In the bond market, yields a little bit lower this morning at the front end, down about a basis point. But Lisa, creeping higher. We've gone from the 440s to the 460s on a 2-year yield in quite a short space of time.
And we're slowly pushing back expectations for a June rate cut. I mean, basically, that's where we're at right now. It's down to 73% from 78% the day before yesterday. How much do we see this continue? Because at a certain point, don't we have to have some sort of capitulation to this idea that maybe rate cuts aren't going to be as great as people previously thought?
That could be dependent on stronger economic data. We might get that later. I was also looking at the ECB, another speaker over at the ECB. This time, I think it was the Greek central bank governor talking up 2 cuts before the summer break. Keep looking at the calendar now. Summer break starts in August for the ECB. 100 basis points maybe this year. That's when you start to think about maybe what's the difference between the ECB and the Federal Reserve for the year ahead.
And what does spring and what does summer, what do they mean? Because that might be what they come down to.
Is that what they're going to do in the news conference with President Lagarde in the next meeting?
Summer? Why do we have to talk about this? More on that later. But honestly, it's fascinating to see the divide, given the fact that the peripheral regions don't need it as much as Germany, and Germany is still the hawk versus some of the others. So kind of twisted state of affairs.
Euro dollar right now, 109.40. Coming up this hour, Russ Kostrick of BlackRock as mega cap tech pulls the S&P 500 down from all-time highs. Tobin Marcus of Wolf Research as a bill to force the sale of TikTok heads to the Senate. And Julia Coronado of Macro Policy Perspectives ahead of PPI and retail sales due at 8:30 Eastern Time. We'll begin with our top story. Mega cap tech pulling the S&P 500 down from all-time highs as traders await PPI and retail sales data later this morning. Russ Kostrick of BlackRock staying optimistic. We remain constructive on the macro backdrop. The Fed's first cut will come in June, and we continue to like growth, including software, healthcare, and select consumer names. The constructive Russ Kostrick joins us now for more. Russ, can I get into the month of June? It feels a little stale, Russ. I keep hearing June, and I'm wondering what informs that based on the information we've had in the first couple of months of this year. What informs your view?
So good morning, Jonathan. I'd start by saying something else maybe, which is that is this necessarily the most important thing that's going to happen to the market this year? So I think June's a reasonable baseline. Our view is the Fed still likely to cut 3 times this year. We had that view coming into 2024. The market started the year differently. But at the end of the day, as you mentioned a few moments ago, the market has been remarkably resilient as we've repriced from 7 cuts down to 3, as we've gone from March to June. And I'd say that whether the Fed goes 4, 3, or 2 is maybe not as important as the fact that long-term yields have been relatively contained. The economy is still solid. We're likely to get 2.5% real growth, 4.5% to 5% nominal growth. That's a good background for earnings. And this is why I think the market has continued to move forward, even as investors have repriced these Fed cuts.
Has the market gotten a little over its skis, though, Russ? And I talk about this with credit spreads on high-yield bonds now at the lowest going back to the beginning of 2022. You've got equal weight outperforming as this rally does broaden out in the equity market. It all began because the Fed was going to start cutting rates. Now they might not cut rates as quickly, and it keeps on going. Is it really justified?
Well, at least I think that's a fair question. I mean, look, stocks have definitely had a big run. I don't think it would shock anyone if we had it, some point in the not too distant future, 5-6% pullback. I do think there's an important difference between 2 or 3 cuts and no cuts. And this is maybe one of the risks that investors do have to be aware of for the market, which is that you can live with slightly less easing by the Fed if it's happening in the context of a strong economy and strong earnings. Now, if we get to a point where inflation is so sticky that the Fed goes the entire year and doesn't cut, yes, I agree that's qualitatively different, and that's something that probably leads us to a different conclusion than if you get 2, 3, or 4, it's probably not as big of a driver as all the other things that have been supporting stocks, including a lot of money coming into the market, a lot of cash, a lot of dry powder still on the sidelines.
Russ, the other thing that I'm struck by is you said that one of the reasons why people have gotten this enthusiasm is because of stability in long-term rates. We saw that again with yesterday's auction of 30-year notes. Pretty successful, strong. Right. And yet we keep talking about how the leverage has been shifted to the U.S. government and how at some point this is going to be a problem and you're going to see it reflected in structurally higher yields. Why doesn't that give you any concern?
Well, I think it is a concern, but again, I think it depends on the time frame you're looking at. I was speaking with clients yesterday. Look, if you're talking about the deficit, I do think this is a real issue. It is structural, as everyone knows. It's not obvious this is going to derail the market in 24. Does it come up in 25, 26, 27? Hard to predict. But again, in the short term, I think the market's going to focus on what is the volatility of rates, what's happening with the Fed cuts to a degree, and the strength of the economy. And as you were talking about a moment ago, the labor market remains remarkably strong. Initial jobless claims remain low. We generally have an environment where earnings are coming in pretty strong. That's more likely to drive the market over the next 2 to 3 quarters, in my opinion, than the federal deficit.
Russ, you have been underweight long-end US duration, though. And if that's not on supply, what's it on?
Well, it is mostly supply. And I think this is where you do start to have some concern about the effect of the deficit, both short and long term. And again, it doesn't mean that you're necessarily going back to 5%, but you've got $2.5 trillion of gross supply you've got to sell. You've got an environment where many of the foreign buyers are, less engaged. The Fed is still shrinking their balance sheet. And the term premium, in other words, the incremental return you're getting for going out on the curve is still relatively small. So when we look across the different asset classes, in our opinion, there are better places to be. We've remained modestly underweight, with most of that underweight on the long end of the U.S. curve.
Russ, you're killing me in the space of 60 seconds. It doesn't matter. It kind of matters. We'll move on. We'll talk about equity markets. Let's talk about your overweight to equities and corporate credit, a bias to U.S. equities, a little bit of Japan as well in the mix. Russ, I want to talk about that little bit of Japan. Seen a big move in the Nikkei year to date on the Nikkei 225. Started to see it pull back after the yen started to strengthen. Russ, what's the relationship between the two?
The yen makes a difference, but again, I think it also affects what part of the market you're thinking of. So Japan is ripped. We still think there's upside. I think people now are well aware of the reasons. Normalization of monetary policy, corporate reform. What I would add to that is, as we spoke about in the beginning, the market globally is run. Japan is still probably the place in the world we still see the best value. Having said all that, I do think we're at a point in the cycle in Japan where you start to shift the exposure a bit. So, for example, banks have had a great run. Are they going to lead the market going forward? Maybe not. Some of the domestic plays, which actually benefit from a strengthening yen. So we still think this market is upside, but you maybe start to think about, where are you in this market relative to where you might have been 3 or 6 months ago?
Russ, just how crowded is that trade in your mind, from your perspective at the moment, given how excited people seem to be about it in the last few months?
When I look at across all of the world, I don't think it's the most crowded. And as you say, it's been a huge run, but let's put it in perspective. You just took out the high, which was established in 1989. And this was a market, I can tell you from talking to institutional investors, individual investors, that no one owned for a very long time. They forgot about it. So yes, people have come back into Japan in the last year, but it was very owned for a very, very long time.
Took a while to get back there, Russ. It's good to see you. Russ Kostrick there.
Thanks, John.
Of BlackRock. Appreciate it. It's underweight the long end of the US Treasury curve. Supply kind of matters just a little bit. On the equity market, let's talk about Japan. Have you seen shares of Toyota over the last 12 months? Just compare the chart to the chart of Tesla, the difference between the two. We're going to talk about the automakers a little bit later. That's not just because it has a Japanese ticker, by the way. That's about Toyota committed to hybrids and not making the move to go into the pure EV play like we've seen from other manufacturers. And they've benefited massively from doing so.
I'd be interested if someone breaks out how much is because it's a Japanese company and how much it's because they're embracing the hybrid. But they are getting it right. It does highlight how Japan is now suddenly this new engine of growth that it hasn't been for so many decades. And it sort of exemplifies why people are going on in beyond just sort of a currency trade that may or may not continue to be a positive one.
Yeah, it's still a question, isn't it? You drop from 150 to 140, 30, 20. Where does that leave stocks?
Well, maybe we won't ever find that out because former Bank of Japan officials coming out and saying probably April is the time, so cool it, and I wonder how much you'll get a weakening in the yen if that happens.
147.82 on dollar yen, unchanged on the session. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Treasury Secretary Janet Yellen says it's, quote, unlikely that market interest rates will return to pre-pandemic levels. The yield on the 10-year U.S. Treasury notes averaged 2.39% in the decade through 2019. But last October, it spiked above 5% after the Fed raised rates aggressively to combat inflation. It now sits just below 4.2%. Saudi Arabia is pushing ahead with one of the largest stock offerings in recent years. The kingdom is said to be in talks to add top Wall Street banks for a secondary sale of shares in oil giant Aramco. Sources say Saudi Arabia plans to hire J.P. Morgan as one of the main underwriters to the offering. Bank of America and Morgan Stanley are also contending for lead roles on the deal, which could raise as much as $20 billion. Rents in Manhattan rising during a busy February for leasing. The median rent for new leases in February came in at just over $4,200, up 3.3% from a year ago. Overall, the number of new Manhattan leases signed in February were up nearly 8% from last year. Rents typically drop during the winter months, but apartment prices haven't let up. That's your Bloomberg Brief. John?
Big month in Manhattan. Yara, thank you. I won't talk about that a little bit later.
Yeah, you don't want to think about it.
Up next on the program, TikTok's fate resting in the hands of the Senate.
We have invested to keep your data safe and our platform free from outside manipulation. We'll continue to do all we can, including exercising our legal rights, to protect this amazing platform.
That conversation coming up next, live from New York City this morning. Good morning. Stocks on the S&P 500 positive here by 1/3% on the S&P after pulling back from all-time highs in yesterday's session. Unchanged on a 10-year, 419.38. Yields creeping higher over the first 3 days of this week. Under surveillance this morning, TikTok's fate resting in the hands of the Senate.
Just wanted to share some thoughts with our U.S. users about the disappointing vote in the House of Representatives. We have invested to keep your data safe and our platform free from outside manipulation. We have committed that we will continue to do so. We will continue to do all we can, including exercising our legal rights, to protect this amazing platform that we have built with you.
Here's the latest this morning. A fight over TikTok heads to the Senate after the House overwhelmingly passed a bill to ban the app or force the sale from its Chinese parent company. The next stop is likely the Senate Commerce Committee. Chair Maria Cantwell saying she's very concerned about Americans' data, but stopping short of committing to taking up the House bill. Toby Marcus of Wolf Research joins us now. He does not think anything happens before November. Toby, can we talk about that? You've got 5 reasons as to why it won't happen. What are they?
Yeah, thanks, Jonathan. So first, the Senate has a long history of killing House bills. This would not be the only thing that's passed the House in huge bipartisan numbers in the past few months that the Senate's just sitting on. Number two, I think we're already seeing key senators show a distinct lack of enthusiasm about picking this right up and move with it. You mentioned Cantwell. You know, she has a kind of competing approach. I think she and other senators are going to chafe at the idea that because the House suddenly sprung into action on this particular bill, they need to follow the House's lead. That's not really the way the Senate operates. Number three, the congressional calendar is a complete mess. This needs some kind of a vehicle to ride along, so I think it's very unlikely it gets a standalone Senate vote. There are not a lot of those vehicles going around, and the closer we get to the election, the more things we're going to shut down and move into campaign mode. Number four, Trump's flip-flop on this, I think, obviously complicates the politics on the Republican side, but less discussed is what it means on the Democratic side. You know, I think heading into a campaign, there's going to be reluctance from Democrats to do this in a way that lets Trump say, you know, I stood against this and didn't want to take away this service that people like. You know, there's sort of an implicit bargain that the blame on this needs to be spread around, and Trump has somewhat thrown that out the window in the past week. And then finally, there are some First Amendment concerns. I think at a minimum, there's uncertainty about how litigation would go based on what we're seeing in the proceedings around the Montana state ban. And that's going to be a concern for some senators also. So, you know, the picture changes the farther out you get, but between now and November, it's hard to see exactly how and when this moves forward.
Given that reluctance, is that why Majority Leader Chuck Schumer put out one of the most vanilla, lukewarm statements I've ever seen come out of the Senate? He's saying the Senate will review the legislation when it comes over from the House. This passed overwhelmingly with bipartisan support, and Schumer's basically like, meh, maybe we'll get to it.
Yeah, I mean, when the House says jump, the Senate doesn't say how high. They say maybe sometime eventually if we feel like it. It's, they have their own bills. I mean, you've seen some of the Senate leaders on this issue get in line. So Mark Warner did come out and say, let's move ahead with this particular bill. But in general, there's a lot of turfiness between the House and Senate. There's sort of no love lost between the chambers, even when they're looking at their co-partisans on the other side of the Capitol. And, it's not surprising at all that Schumer is responding in this, as you say, essentially empty way that leaves all his options open based on how conversations go.
TikTok, though, is still under CFIUS review. So if Congress doesn't act, what happens to that review?
Yeah, I mean, that's a great question. We're now on, year 3, 4 of that. I think the general understanding has been that the administration is apprehensive about moving forward with their, I think, fairly open preference to compel or sort of influence the divestiture based on concerns about how it would go in court if they attempt to order that. I think the kind of paper trail going back to 2020 under the Trump administration about the sort of considerations here and whether or not you can mount a sort of plausible national security case that's free of politics is a concern. But everyone I talk to, both inside and outside of the administration, has a distinct lack of confidence in their ability to prevail in court if they were to move forward there. So, it seems to me like that probably stays in limbo, too. They obviously don't want to sign off on the Project Texas mitigation plan that the TikTok folks have moved forward, but they also, I think, understandably are not eager to take their chances in court.
And the idea of divestiture becomes even more complicated when you have all the arguments over who is an acceptable person to buy said TikTok, right? I mean, how realistic is it that there would be any kind of agreement on which company would be viable, which company has the funding, and what the government's role is in facilitating that?
Right. I mean, I think the biggest obstacle is from Beijing's side. They have said openly that they're not interested in approving a divestiture, sort of at the point of a gun from the U.S. side. And of course, that's been the message from ByteDance. Also, you're playing the video before. They're going to exhaust all their legal options. They're sort of going to fight this to the end of the day before going along with this. The logistics around is sort of figuring out who has the financial capacity to absorb this, who would actually make sense as a buyer, sort of how you manage the antitrust concerns. Those are all very real also, particularly on the short timeline that's specified by this bill. But, I think the biggest obstacle is probably from the Chinese Communist Party in terms of willingness to approve it.
That's an interesting point. I want to finish on the former president as well, Tobin. We've talked about this over the last few days. Complete 180 from him from where he was about 3-4 years ago on this issue. And we're trying to figure out what that could mean for US-China relationships under Trump Volume 2. What does that look like, Tobin?
Yeah, absolutely. I think that there's a prevailing expectation that U.S.-China tensions just get sort of uniformly worse under Trump. Obviously, he has this proposal for a 60% tariff on all U.S. imports from China, which would be quite a drastic escalation of the trade war. But I think we saw in the first Trump administration, and we're seeing again now, that there is a great deal of transactionalism. And so sort of if you're willing to flatter him, both from a U.S. side, from Xi's side, there's the possibility, I think, for kind of selective easing on various different points. Like in the early days of COVID, he was quite complimentary of Xi and the Chinese Communist Party's COVID containment strategy, based on the fact they were trying to kind of close the phase 1 trade deal at the time, including a big sale of U.S. soybeans. So, the Chinese are using this as a propaganda tool, not least in Taiwan. There's a pretty open effort to try and tell the Taiwanese, if your story of how you continue asserting independence from the mainland is by relying on the U.S., Trump is not the guy who's going to be there for you because you sort of can't count on him to stay strong on these various kind of hawkish positions if political winds change.
Tobin, really thoughtful stuff. Appreciate it, sir. Tobin Marcus there of Wolf Research. I just want to pick up on a couple of points. The one point is I think we're all sitting here assuming that ByteDance would actually sell it. And we're going through a list of US companies that have the money, it's a long list, and a list of US companies that might get the green light from Washington, much shorter list. Also got to consider the fact that maybe they won't allow it to be sold.
Which is what he thinks is the more likely potential vehicle, and what this could do to the tit for tat in terms of the messaging domestically in China.
Much more on TikTok throughout this morning. Coming up next, Bloomberg's Craig Trudell on troubles facing Tesla and the EV market. That stock is down again this morning. We're negative 1.4%. Live from New York, equities positive across the board here, up a third of 1% on the S&P 500. We'll talk about the morning and the data we'll get a little bit later in just a moment. On the Nasdaq, we're positive by a half of 1%. The Russell, the small caps doing okay, up 0.2%. Let's check out the bond market together. I want to talk about the front end of the yield curve, looking at a two-year yield right now, yielding 4.6260. Yields on Monday, up 6 basis points. On Tuesday, up 5, up another 5 on Wednesday. Lisa, a little bit lower this morning, but yields have started to grind higher through the week. We started this week at about 4.48. That's where we opened. We're now in the 4.60s.
People are flirting with fewer rate cuts. Not no rate cuts. They kind of dismiss that as being a bit of histrionics, but they do say the market collectively, if the market had a voice, we're not so sure about how many rate cuts can really come this year, given the hot CPI print we got and given the fact that economic momentum still continues to chug along. The key question is when this becomes harmful, when higher rates actually seems to suggest slower growth going forward, because right now it's something that this market thinks this economy can handle just fine.
That's not happening whatsoever in any way, shape or form.
Correct.
Looking at the headline numbers on aggregate, let's turn to foreign exchange. Let's push this through FX. Now, this is a question Lisa has asked a lot, and ultimately Morgan Stanley and Ellen Zentner pointed out just yesterday in their note where the FX strategists were, which is they expect euro-dollar to decline as markets increasingly price in the likelihood of a Fed ECB policy divergence. And the fact of the matter is, that all makes a lot of sense. But in reality, that's not how things are playing out. Euro-dollar's now at 109.39. We have not seen that pronounced weakness, that move towards parity that the likes of BNY were talking about recently on this programme.
And the reason why, I mean, Jeff, you said it was because of positioning. I don't know the answer to this. Is it because people think that the Fed isn't going to necessarily remain as high as they are, that they're going to cut more aggressively? Is it because they think that the euro region has already been priced for recession, is actually doing better than that? I'm not sure what this is sort of suggesting, because if you just look at the narratives, it would make sense for the dollar to be a whole lot stronger.
I posed the question, I raised this, I think, in the last couple of days. Have we seen peak US exceptionalism? And I think a decent example of that right now might be what's happening with sterling. This stealthy rally back towards 130, 128.13, plus another 0.1%. Is the growth inflation mix improving in places like the UK, where it's been pretty terrible over the last year or so?
It's a great question. And has it peaked, or are people just getting sick of it and concerned that it's overly crowded, so looking for other places to potentially dip their toes and say what looks cheap? Because that seems to be what everyone seems to talk about. Later on in this cycle, it'll look great to go into small caps and go into international stocks, and you might as well get ahead of that, even if it's not happening just yet. How much is that what we're seeing versus an actual peak that people have been calling for quite a while?
Mandy Zhu, SIBO, what did she talk about yesterday? Not about foreign exchange, she was talking about equities. They were dying, crying out loud to get that move, that shift away from large cap tech towards where? The Russell, small caps. That's where the options market was leaning into with an upside bias, and has been for a while.
It has been for a while, looking for that shock upward move. If you take a look, for example, since the middle of February, the Russell 2000 has still underperformed, even as the equal weight outperforms, even as you see small caps, or rather the large caps, not necessarily outperforming. Russell just still hasn't gotten off the mat.
The Russell this morning up by 0.2%. Under surveillance today, US retail sales PPI data due out at 8:30 Eastern time. Traders waiting to see if the inflation report will confirm or deny this week's hotter than anticipated CPI data. Bloomberg Economics expecting PPI likely rose 0.4% month over month from 0.3% prior. Investors will also be looking for a possible rebound in retail sales after weather and seasonal adjustments weighed on the figures from January. Retail sales PPI, jobless claims, take your pick. What are you focused on?
I mean, PPI is going to be interesting because it is the last inflation read before the Fed's meeting next week. And it does go into the PCE core reading that the Fed likes to look at. So put that aside for a second. Curious to see if you do get a hotter than expected PPI report, does the market finally react the way that we think that it ought to, given what a lot of people were saying before CPI?
Well, the way they set up for CPI and how they reacted after maybe means PPI will be, to your point, a little bit of the same. I'm interested in retail sales. We talked about what Walmart CFO had to say in January. The Walgreens CEO, similar. Retail customers in the U.S. are under stress and making deliberate choices to seek value. So does this resilience continue, or do we start to see a little bit more cracks? Is it going to be seasonal, or is it actually going to be softer?
Data drops in about 2 hours' time. Let's get the Janet Yellen view of the world. The Treasury Secretary, Janet Yellen, warning we may be in a new normal for interest rates. Speaking to reporters on Wednesday, Yellen saying, quote, I think it reflects the current market realities and the forecasts we're seeing in the private sector. It seems unlikely that yields are going to go back to being as low as they were before the pandemic. Yellen's comments come during a trip to tout Biden's economic policies, including the Inflation Reduction Act. Treasury Secretary Janet Yellen hardly with a controversial take on the bond market at the moment.
Well, here's the thing, though. She's shifted her language. January 2023, she said they were more likely to come down, in line with where they were before the pandemic. January 2024, she said the jury's still out. And now she says it's unlikely.
What did she say to Fox Business yesterday?
Well, to Fox Business, she said she regretted saying inflation was transitory, but then she did explain that I think for most people, when they think transitory, they think days and months, not in years, and potentially maybe it's how you define transitory is the issue.
That was the apology.
Yeah, that was the apology. She has said she regretted it before. To be honest, though, from my reporting, it was Janet Yellen that was the one behind the scenes saying we should be a little bit careful on inflation. It might not be as quick as you are expecting. But she also said the trend in inflation is favorable, but it might not be smooth. That's exactly what the Fed's dealing with.
Let's think about things that aren't smooth, and that's getting deals done in Washington, D.C. at the moment. So President Biden expected to voice new concerns over the proposed deal from Japan's Nippon Steel to buy U.S. steel. Shares of the Pittsburgh-based company falling by the most in nearly 4 years. Nippon is offering to buy the company for $55 a share in cash. In a joint statement, the company saying the deal will strengthen U.S. jobs and national security. The comments coming as Biden hits the campaign trail in Rust Belt states like Wisconsin and Michigan later on today. Look, if you think it's difficult at the moment between the likes of ByteDance and Congress in Washington, Japan's an ally. Japan is an ally, and we think there's national security concerns around this.
Well, this is, to me, the issue. You're doing this right before, the representative from Japan is going to come and to really join the White House. It's kind of an embarrassment, as some people are saying, to basically double down on this. And it also raises this question, do you put your campaigning to try to become the most union-friendly president out there ahead of an international relationship that's key to potential national security?
100% right, Lisa. This is going to be one of the most awkward state dinners because the statement will come before the prime minister heads to Washington. But this is an election issue. Trump said he would ban it outright. In February, the union said they received, quote, personal assurances that Biden has our backs. Look at Pennsylvania. Trump won Pennsylvania in 2016. Biden won it in 2020. This is an election issue. I don't think this is a national security issue.
Look out for a statement a little bit later, potentially. Let's move on to Tesla. The slump continuing, hit by a downgrade from Wells Fargo, calling it a growth company with no growth. Shares closing at a 10-month low yesterday while losing nearly a third of its market cap to start the year. In more struggles for EVs, startup Fisker is plunging after a report from the Wall Street Journal warned the company is preparing for possible bankruptcy. Bloomberg's Craig Trudeau joins us now for more. Craig, we got yesterday a downgrade to Tesla from Wells Fargo. We'll catch up with Wells Fargo a little bit later. We got an upgrade on traditional automakers in the US from Morgan Stanley. Where's this market going, Craig? Where is it right now?
Yeah, I think to add to that, just this morning we have UBS out with lowering their price target on Tesla to 165. I think they were 225 beforehand. So I think what we're seeing with Tesla is just a very clear, indication on the part of their IR team, kind of canvassing the analysts to say, look, you guys need to take your numbers down and really setting expectations much lower for the first quarter of the year when we look at what's happening in the U.S. and in China with a real slowdown in momentum for EVs, and with Tesla, saying to start the year, look, we're going to have a notably lower growth rate. I think this is a case of, we haven't necessarily seen consensus come down to sort of, respond to that. And so we're seeing, delivery expectations dialed back to a significant degree, price targets and recommendations being adjusted as a result of that. And Morgan Stanley, coming out and really sort of, questioning whether or not it made sense to spend as much on EVs, which I think, is a little bit late, to be honest. I think we've already seen the likes of GM and Ford and others, really dial back their investment in EVs, and even, in Volkswagen's case over here in Germany, altogether cancel a plant in Wolfsburg.
Yeah, the South Side catching up big time with this move that we're seeing in Tesla's stock. Craig, it's not just lower growth, it's no growth. I was going through the estimates coming from Wells Fargo. No growth this year, negative volume growth next year. I've got no idea what kind of multiple you should put on a name with no growth when it has such a growthy multiple. Greg, then I look at other names like Toyota. Fact of the matter is the auto sector's doing decently. It's just the pure EVs aren't doing well at all. It's the hybrids. Craig, I remember you and I talked about GM maybe entertaining the idea of leaning into hybrids. Is that where the market market is right now, and who's to say it's going to stay there for the next 12, 18, 24 months?
I mean, it absolutely is where the U.S. consumer is. And I think we're seeing acknowledgments even in Detroit of this idea of, you know what, maybe we need to rethink hybrids. And I think Keith Naughton in Business Week just a few months back had a great, in-depth story about the fact that Ford, which, just a year and a half ago was really, sort of beating their chest about, bringing out the F-150 Lightning, the amount of investment that they were putting into EVs. Jim Farley really sort of talking about this being the way forward and sort of setting its sights on Tesla. I think, Farley is a former Toyota executive, led Lexus for a time. I think they've really sort of, rethought their plans. And you're seeing, a hybrid F-150 offering. You're seeing Toyota not being able to keep up with demand for models like the Prius and, the hybrid RAV4. I think we're absolutely going to see some challenges with, some pushback on the part of the consumer in the U.S. And, even over here in Europe, I think, Toyota sort of sneakily, under the radar has really built a heck of a business, building and selling hybrids when, 10, 15 years ago, the Germans wanted us all to go the direction of diesel, and we all know how that ended up. So I think Toyota has not gotten the credit that it probably deserves, questioning just how ready the consumer was to go fully electric. And this is, a palatable solution to bring emissions down from where they would otherwise be, while not necessarily where the regulators would like the industry to get to.
Craig, I wonder if we can write the chapter on electric vehicle subsidies, the idea of some of the discounts that people got for buying EVs in the United States. Was that a failure?
I think it's been a really complicated issue in the U.S. in that, in order to bring those back or sort of give them a new lease on life, Joe Manchin insisted that he needed an American supply chain for batteries and for EVs to be made in America. And that's all well and good. It's of course, very much in keeping with the Biden administration's agenda. But the huge complicating factor in that is we don't have a battery supply chain in the U.S. We don't have mines and processing and capabilities to bring cheap EVs to market the way that China does. And so if we're going to push the industry to do that, it's going to take some time, and it's also really going to go through some growing pains, because it's going to be more expensive than it is in China for quite a while before we even sort of start to close that gap. And if we're not willing to sort of put up with the challenge that's going to be, then it is going to ultimately end up in failure.
So to breathe some new life potentially into the EV market, the U.S. would essentially have to say not all of those goods need to be produced in America or allies, and actually welcome some of the supply chain components from China.
I think there's absolutely some pushing on the part of some members of the industry to say, look, we need some relaxation on these rules. On the other hand, you have parts of the supply chain that say, look, we need the support of the industry and to sort of move forward with this plan to sort of wean ourselves off of China, or else our projects that we're trying to get going in response to the IRA are just not going to survive. They're not going to be viable. And there's a real sort of tension within the industry and within some of the players that aren't necessarily typically working with automakers and their suppliers of exactly how quick do we need to move in order to make this all work. And I think a real sort of you can also tell some hesitancy on the part of folks in Washington, where essentially every time that the Treasury Department has had to make a decision about how quick they move with some of these rules and when are they going to formally implement some of these requirements, they've pushed things back. We've seen so much can kicking, and I think that's something we're going to continue to see.
This started in the UK. Big reality check, just pushing back the timeline. Craig, great to catch up. Craig Trudell of Bloomberg out of London this morning. My favourite graphic right now is just the 1 year move that we've seen in Toyota versus Tesla. This is hybrids versus EVs right here. Toyota is up by more than 90%. Tesla is down by 7 over the last 12 months. It's much worse year to date. They've lost about a third of their value. And a quote from Adam Jonas of Morgan Stanley jumps out to me. I saw this yesterday. EVs may be the future. They're struggling to be the present. Hybrid sales are growing 5x faster than EVs in the United States. That is where the market is right now.
And that's where the hopes and dreams have been shattered when you take a look at Tesla down that much and down so much from its peak that was reached, I believe, in 2021. We have seen peak hopes and dreams for electric vehicles, and now we're starting to build on what the present is in terms of what people want to buy.
Big time. That conversation is going to continue a little bit later. Just a programming note for you. We'll be speaking with Colin Langan of Wells Fargo on Tesla at 8:45 Eastern Time after calling the EV maker a growth company with no growth. That story coming up just a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. A bill aimed at forcing a sale of TikTok is moving forward on Capitol Hill. The House passed the TikTok divestment bill by a vote of 352 to 65. It now heads to the Senate, where its prospects are less clear. Majority Leader Chuck Schumer has only said he'll review the bill, and members, including Republican Rand Paul, have come out against it. While investors await the highly anticipated Reddit IPO, the social media company is giving guidance on its expectations. Bloomberg News has learned Reddit is telling potential investors it expects revenue in 2024 to grow by more than 20% versus the previous year. According to its filing with the SEC in 2023, the company saw revenue come in at just over $800 million. Donald Trump is starting to think about what his cabinet would look like if he's reelected in November. Bloomberg is reporting the former president is set to be considering billionaire John Paulson as his Treasury Secretary. Other potential names in the mix for the post include former U.S. Trade Representative Robert Lighthizer and billionaire Jeff Yass. That's your Bloomberg Brief. John?
Yahara, thank you. You know how this is going to go. It's going to be like casting for a Hollywood movie. It's going to go for months. The rumour mill's going to be overdrive. He's going to do some speeches and just throw out random names. This is going to go on forever.
Well, that's what happened with John Paulson. He spoke after the New Hampshire primary saying that guy makes money anywhere, everywhere he goes. Even though he was making money in Nevada, he can make money anywhere. Maybe he'll be my Treasury Secretary.
Maybe the VP. Who knows? Up next on this programme, the Fed's elusive inflation target.
The market got way ahead of the Fed earlier this year when the market was pricing in 6 to 7 rate cuts. The Fed wants to be sure that they're actually going to be successful in getting inflation all the way down to 2%. And the not so good inflation prints that we saw recently, just reinforce that.
That story up next. Big morning for economic data just around the corner. This is Bloomberg. Stocks rallying by a third of 1% on the S&P 500, a little bit of a lift. Yields going nowhere. 10-year just short of 420, 419.19. Euro slightly weaker, 109.38 against the US dollar. Under surveillance this morning, the Fed's elusive inflation target.
The market got way ahead of the Fed earlier this year when the market was pricing in 6 to 7 rate cuts. The Fed wants to be sure that they're actually going to be successful in getting inflation all the way down to 2%. And the not so good inflation prints that we saw recently, just reinforce that. So I think the world is sort of going the way the Fed Reserve was expecting rather than the way markets were expecting. And I think there's plenty of time to see how the balance between growth and inflation plays out.
Here's the latest this morning. The Fed expected to keep rates on hold at their next meeting next week after 2 hot CPI prints to start the year. Julia Coronado of Macro Policy Perspectives writing this. We expect the Fed to hold rates steady in a unanimous decision at the meeting next week. Our base case is that the Fed will indicate they are in a holding pattern for now with minimal changes to the policy statement and their baseline outlook, including the expectation that 3 rate cuts will be appropriate this year. I'm pleased to say we can catch up with Julia now. Julia, I want to talk about the difference at the moment between what we see in CPI and what you expect to see in PCE. The chairman was looking for a little bit more confidence. I wonder from your perspective whether he might have lost some.
That is the question. And certainly after the January reading, what we were hearing from Fed officials was it was sort of an anticipated bump on the road. So as Bill Dudley was just saying, the market had gotten ahead of the Fed. The Fed had built in bumps on the road in their baseline outlook. That was why they had a more patient path for rate cutting than the market earlier this year. The question is whether February has rattled that confidence. February was only a little bit better than January, another bump on the road perhaps. We're going to be watching whether the Fed raises its forecast for core PCE inflation for year end and whether it reduces the number of cuts in its baseline from 3 to 2. It doesn't sound like they need to do that right now. And, they can 3 rate cuts. They could start in June, July, and they'll have more data in hand by then. They are not in a rush. And I think that's the holding pattern idea. They haven't gained more confidence. They haven't necessarily lost confidence. This is sort of an expected bump, but they will have more data ahead, and they can take their time and gather that data.
You say this is an expected bump. Is there anything about the recent data that surprised you, that's made you kind of rethink a couple of your baseline assumptions?
That's a great question. I would say, the January data, we had that worrisome jump in housing inflation. That then reversed in February. So actually, that was a bit reassuring. We were very much on alert after the January reading. But there's still the open question as to when that housing inflation takes another step down. It stepped down last year. All the leading indicators say it should cool further. It really hasn't yet. It's been kind of flatlining for about 6 months or so. So that's one thing that, we think that we are going in the right direction there, but we really need the data to confirm that. And the timing and the magnitude are highly uncertain. So that raised a question about when exactly we are going to see that break down to a new range in housing inflation.
Have you rethought, Julia, the longer-term rate expectations? And I'm talking as Janet Yellen brings up the fact that probably we're not going back down to pre-pandemic levels on rates. Do you feel like the recent data has confirmed that this is a new dynamic in the economy that will leave rates higher and inflation higher for a longer period of time?
Yeah, I mean, certainly I think that rates are probably going to land at a higher level this cycle. I think that doesn't necessarily have to come with higher inflation. I think the Fed can get down to its 2% target, but I think the economy has a better productivity trend this cycle. We're not deleveraging like after the GFC. There's a lot of indications, business formations, the labor market resiliency, the investment strength that we've seen from businesses, that, we could be on a better productivity trend, and that would mean a higher neutral rate for the U.S. economy. So that isn't necessarily where we are right now. I don't think 5.5% is the new neutral, but it could be 3 to 3.5%. That seems perfectly reasonable.
Julia, you're fantastic at this, so help us out. When we get PPI a little bit later on this morning, what are the pieces of PPI that you're more focused on than others?
Okay, so there's a few key pieces. The overall and the, core PPI don't necessarily mean anything for us. What we're looking for is airfares, some components of financial services, some components of medical care. Those are directly taken from the PPI and go into the PCE. So we will get a much better handle on whether PCE is going to be better than CPI or worse than CPI after we get the data this morning. And that, what we saw in the December press conference when Chair Powell acknowledged that they updated their forecasts after the PPI on Fed Day. The Fed's watching this data just as closely as we are. So it's going to be important to see those details.
That's the clinic we needed. Julia, thank you. It's good to see you, as always. Julia Coronado there of Macro Policy Perspectives. Just got a headline from the president. We were talking about US Steel. Here's the headline right now. US Steel should remain domestically owned and operated. Annmarie, your take on this one?
Well, that's what I said before. This is an election issue, and this is about shoring up union votes we cannot stress how critical Pennsylvania is for both of these men. Trump won it in 2016, Biden won it in 2020. And this just says to me that election issues of the unions and American jobs is coming before a key ally. This is not China. This is not Russia. This is not Iran. This is Japan.
This conversation will continue. Coming up next in the next hour, Mark Lashini of Jenny Montgomery Scott, Brian Weiser of Madison & Wall, Mark Lifschultz of Blue Owl Capital, and Rolf Haben-Jansen of Hapag-Lloyd. That conversation coming up shortly. The second hour of Bloomberg Surveillance up next.
we have continued to see equity markets continue moving upward.
Companies are doing well. Earnings are positive. We're out of the earnings recession of last year. Fundamentals are good.
Earnings came in very strong. I think that's going to be what is propelling stocks higher going forward, is the fundamentals.
Households and businesses are still in very good shape from a balance sheet perspective.
We are kind of approaching that better equilibrium in the corporate earnings cycle.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market's positive by 1/3% on the S&P 500. The Fed is in a quiet period. We've had very little data in the last 24 hours, so the market narrative driven by the price action of the last 5 minutes or so. That changes this morning in about 90 minutes' time. PPI, retail sales, jobless claims, coming right up.
Okay, so does it matter? Is it going to change the narrative at all? Because frankly, CPI was supposed to be the most important risk-on or risk-off event of the week. It actually did have some interesting nuggets, and it was treated as a dud in the market. So honestly, when will this market take signal from the data that's being dismissed as only one data point, even though we're data dependent?
Would you prefer to talk about a single name instead?
Yes.
Because we can do that. US Steel is down by a little more than 5% at the pre-market. This stock got absolutely hammered in yesterday's session. This from the President of the United States this morning. US Steel should remain domestically owned, Annmarie, and operated.
Yep, we were waiting for this statement. We thought actually it was going to come, according to the FT first reporting that, going to come in a few weeks, but the White House must have felt a tremendous amount of pressure after this leaked. Biden, first off, this has been under CFIUS review as well for national security concerns, but Biden had already pledged, according to the unions, that, quote, he had their backs. He is really choosing the election, the politics of this, union workers, over if there's any potential national security. The bigger issue is this is an ally. And to Lisa's point earlier, how awkward is it going to be when Prime Minister of Japan comes for a state dinner and they decided to block, looks like they're going to block this deal, or clearly putting their thumb on the scale here.
Here's the statement from the president. It's important that we maintain strong American steel companies powered by American steel workers. I told our steel workers I have their backs, and I meant it. US Steel has been an iconic American steel company for more than a century, and it is vital for it to remain an American steel company that is domestically owned and operated. It is 2024, it is election year, and it is not business as usual in America in any way, shape or form.
National security is doing a lot of heavy lifting. It's doing heavy lifting on every front. We're talking about potential national security for this U.S. Steel deal. We're talking about national security when it comes to vehicle manufacturers and what we import or export. We're talking about national security with social media. Will this be the sort of catch-all phrase when someone doesn't like something and wants to have an opinion on it? Oh, national security concern. And what is the risk that true national security concerns get muddied by a sort of political usage of that kind of phrase?
Nailed it. US Steel this morning, TikTok yesterday, Chinese EVs a few weeks ago. Let's talk about EVs. When are we going to find out the final call on what's going to happen with EVs coming from China?
Well, that's something else that the Commerce Secretary is looking into, and also Treasury, I imagine. The president said that potentially we can see more of a tariff on these EVs. But the tariff now is north of 25%. It's 27.5% for China EV coming in. So no one's really going to be buying a Chinese EV with that kind of tariff. The issue is, though, what happens is potential backdoor. BYD is looking into Mexico. Can these BYD vehicles made in Mexico end up making their way to the United States?
US Steel down by almost 5% this morning in the pre-market. Yesterday, absolutely hammered. US Steel was down by almost 13%. The broader market's doing okay. Away from this, equity futures are up on the S&P 500 by 1/3%. Stocks are higher, bouncing back from yesterday's losses after pulling back just a touch from all-time highs. In the bond market, yields going nowhere on a 10-year, 4.1860. Going somewhere Monday, Tuesday, Wednesday, though, Lisa, and that somewhere was higher at the front end of the curve.
But in a controlled way. And this is the sort of fascinating point. Tick by tick, people are pushing out their expectations for Fed rate cuts. And you could see yields just ticking up marginally. But the auctions haven't been terrible. Yesterday was actually good. You've seen sort of this rush of money into bonds, despite some of the longer term concerns, which raises this question, what narrative should we follow next? Because honestly, at this point, nothing is being consistent and working.
The 2-year, 462.39. You're not frustrated about this at all, are you?
This is a frustrating market. It is. I think that there is a sense, I asked asked one person, how has it been? They said, it's really boring. And I said, what are you doing? And they said, we just have to resist trying to trade because we're bored. And there is this feeling out there where it's sort of finger in the wind. When do we actually get something definitive?
I'm guessing that person wasn't bullish, because if they were, they would have said it's really chill. It's like boring when it's not going well, but it's pretty chill when things are going well, right? I'm guessing they were pretty bearish?
Actually, they weren't. It's just that it's a boring trade to continue with because it's been the same one and there's not a lot of nuance to it. So all of the creative ideas of how things are going to percolate out aren't really working.
They're not entertained by AI and GLP-1s.
Sure, but if it works, then it keeps on working,
Coming up on the programme, more on AI and GLP-1s. We'll catch up with Mark Lascini of Janney Montgomery Scott on why tech is, quote, ripe to cool off. Brian Weiser of Madison and Wall on what the TikTok bill means for US social media companies. And Rolf Haben-Jensen of Hapag-Lloyd on the, quote, volatile and challenging outlook for shipping companies. We begin with our top story. Big tech pulling the S&P 500 away from all-time highs ahead of more US inflation data. Mark Lascini of Janney Montgomery Scott saying it's time to look elsewhere, writing this. While we continue to favour many of the mega tech and tech-related companies, longer term, they are overbought and ripe to cool off. Developments in industrials, materials and energy are encouraging and present newer opportunities. Mark, I'm pleased to say, joins us now. Mark, let's get into those newer opportunities. What is it that you like about energy right now?
Well, I think a couple of things, and good morning. I think part of it is getting kind of caught up in this cyclical trade that has migrated out of some of these tech names and helped to prop up some of those cyclical areas that you had just talked about that I forwarded you in my notes. I mean, industrials and materials in particular over the last month, but energy is among them. And of course, we know that OPEC Plus has been somewhat stringent with regard to their supply, and we've not seen the kind of diminution in demand we otherwise might have expected coming into this year, particularly from some of the big oil-consuming countries, including the U.S., but also China and India and others. And as a consequence of that, OPEC is still projecting that we're likely to see 1.5% to 2% demand growth year over year. And again, with the constraints on supply, even though we're seeing some oil being pumped out of Libya and Nigeria above levels that was expected otherwise, it seems to be enough to put a bid into oil prices. And with the dollar having weakened here by about 2.5% to 3% over the last month or so, that's also helping to be supportive of oil prices. So net, with a decent economy here domestically and some improvement we're starting to see emerging globally, to me, that is the ingredient for why oil prices are being propped up and could even continue to grind higher. And so obviously a profitable scenario for an energy patch that has been a laggard over the last 12 months or so.
Echoing that, the IEA out early this morning basically saying because of those OPEC Plus cuts, the market faces a supply deficit all year, not just the next few months, but all year 2024. Mark, we've been raising the question, though, why hasn't crude rallied more? We're at 80 just about on WTI, reclaimed that very recently. Brent crude at close to 85 at 84.68. For this to work for you, do you need crude prices here, or do you need them to keep rallying?
I don't think it needs to go up significantly higher. I mean, it's actually somewhat surprising, perhaps, over the past 4 or 5 months, actually. Obviously on the back of the breakout of the war in the Middle East and concerns around Iran's proxies contribution to that exercise taking place that could have ramifications in the Strait of Hormuz or the Suez Canal, and obviously higher prices to ship oil to avoid those areas that are, sort of white hot with regard to the turmoil taking place over there, that there isn't more of a geopolitical risk premium that's been bid in. And I think it's interesting that investors have tended to look through that, or at least assume that it's fairly localized at this juncture and isn't likely to cause an unwarranted spike. But I think nonetheless, at $80 plus for West Texas or more for Brent, that's still exceedingly profitable for these energy companies that are becoming very disciplined with regard to their capital allocations and made technological advances that have lowered their break-even rates such that they don't have to see significantly higher oil prices for them to be exceedingly profitable. And as a consequence, even though they've had some tough comps coming off of 2022 throughout 2023's earnings season, earnings are expected to improve markedly over the next 12 months.
When we broaden out here, there's a pretty big implication in the trades that you like. It's energy, it's also materials, industrials. It's the stuff that really underperformed in the past year or so as we sort of came to the services after the goods-focused pandemic buying sprees. Does this imply that the goods inflation, the reinflation that we're seeing could continue because suddenly all of that demand is getting diverted back into goods after a brief hiatus that we're going to see come through this PPI and other readings going forward?
Well, I think that's a great question, and I do believe there's an element of that. If you look at some of the numbers, and I think Lisa was mentioning it, that it's amazing that investors kind of look through the CPI number and even last week's PCE number with regard to particularly what had been talked about by Jay Powell, no less, the core services ex-housing or super core inflation, which actually moved up on a month-over-month basis, and is still at 4.3 on the CPI core services ex-housing number, well above the kind of inflation readings that the Fed would like to see, because a big component of that is wages. And we just got an update from the Atlanta Federal Reserve with regard to their wage tracker that's showing that wages on a year-over-year basis flattened out in February at 5%, again, similar to that of January, which is, again, well above what corresponds to an inflation rate of 2%, which Jay Powell says earmarks closer to 3%. So I think perhaps some of this reflationary narrative is bleeding into some of these sectors. Now, there's also a tsunami of fiscal monies being leaked out of the CHIPS Act and the IRA Act that is helping to propel companies' profitability, particularly in the materials like cement companies and infrastructure build out here domestically. And defense spending obviously is benefiting from, unfortunately, the breakout in global tensions, which is not just the U.S. phenomenon, but a European one as well. And so that's helping to provide feedstock to those companies that propagate industrials and materials. But also, of course, we spoke of energy. But, you can also see it in some of the base metals that are percolating. Look at copper prices moving above $4 a share. Gold has certainly broke out to new all-time highs, but look at silver now breaking above $25. And even lithium looks like it's starting to form a bottom. So, collectively, some of this obviously is supply related, but it also may be indicative of perhaps a reflationary impulse that's starting to emerge, not only here in the United States, but also globally, which isn't to say we have to see a renewed bout of hyperinflation, but rather perhaps inflation may remain high and perhaps much stickier at levels above that which would otherwise might have been sort of treated as an expectation that its descent is going to continue linearly all the way down to 2% and stop.
Big focus on commodities. Mark, we've got to leave it there. Thank you, sir. Lots to think about. Mark Lashini there of Jenny Montgomery Scott. Kelly Kaminsky, Alpha Simplex, talking about exactly the same thing yesterday. That's where she's focused.
This is what's in my mind right now. How long can that fiscal spending continue without some sort of commensurate reaction in the bond market? How long can you get that transfer from the government to all of these industries without people saying, oh, wait a second, where has the leverage shifted? And this is the reason why I like auctions. This is the reason why I care about this, even though I might be, 15 years too soon.
I've got an interview that you might like as well. Ken Rogoff, David Westin,
yes,
Wall Street Week. I knew you would. Reading your mind. Here's the quote from him to Westin. Washington in general has a very relaxed attitude towards debt that I think they're going to be very sorry about. It's not just the free lunch that Congress and perhaps the two presidential candidates have gotten used to. He doesn't know the upper limit of all of this, and nobody does. But ultimately, the base case is at some point, they're going to test it.
Well, we got data this week from the Treasury, $433 billion in the fiscal year so far because of interest costs. That's more than 40% that was spent the prior year. Paying off our debt is going to become in the next decade the top line of the U.S. budget. That's insane when you think about it.
Well, to me, the issue is going to be when there's true weakness. Where is the impulse of the U.S. to actually spend to support the economy? Because if you're borrowing into weakness, could you see a really much more difficult climb in benchmark rates? And that, I think, is really kind of where the rubber meets the road.
As soon as I saw that quote, I thought of you. Look out for Wall Street Week a little bit later this weekend with David Westin and Ken Rogoff. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The bill proposing a TikTok ban on U.S. app stores now heading to the Senate. This as China calls on the U.S. to stop, quote, unreasonably suppressing the app. In an exclusive interview with Bloomberg's Stephen Engel, U.S. Ambassador to China, Nicholas Burns, weighing in.
We've heard a number of complaints from the government here in Beijing this week about the American debate on TikTok. I find it supremely ironic because government officials here are using the X platform to criticize the United States. They don't give their own citizens the right to use X, to use Instagram, to use Facebook, to have access to Google. And so it is ironic indeed that the government here is complaining about a process when they shut down access for 1.4 billion Chinese to all of these platforms.
While investors await the highly anticipated Reddit IPO, the social media company is giving guidance on its expectations. Bloomberg News has learned Reddit is telling potential investors it expects revenue in 2024 to grow by more than 20% versus the previous year. According to its filing with the SEC in 2023, the company saw revenue come in at just over $800 million. Rents in Manhattan rose during a busy February for leasing. Median rent in February came in at just over $4,200. That's up 3.3% from a year ago. Overall, the number of new leases signed in February in Manhattan were up nearly 8% from last year. Rents typically drop during the winter months, but apartment prices are not letting up. That's your Bloomberg Brief. John?
Yahira, thank you. Just got a tweet. Do you see this? You'll like this. Okay, it's about you, Bramo.
Oh.
You seem stressed. You might need a vacation.
Well, you
This
know.
is just how Lisa gets about the bond market.
Airfares are going
Really?
up.
First time viewer, Bramo.
It's pretty much, you know, evergreen statement.
Up next on this program, the TikTok bill heading to the Senate.
I want to divest the Chinese Communist Party from our data, but here's the problem. If you shut down TikTok and there's no competition for Meta and Facebook and Google, they become the most dominant force in America.
That conversation just around the corner. Live from New York City this morning. Good morning.
That way I'm talking it.
No. Okay? No. We're not doing that. Equities right now on the S&P, positive by a third of 1%. Yields look like this. A 10-year, 4.1879. In foreign exchange, the euro, 109.40. Bramo, get it together. Under surveillance this morning, the TikTok bill heading to the Senate.
I want to divest the Chinese Communist Party from our data. That's going to require American sale. So I'm leaning yes, but here's the problem. If you shut down TikTok and there's no competition for Meta and Facebook and Google, they become the most dominant force in America. So I'd like to have somebody in the conservative world buy TikTok.
I love the end piece of that. We can get into that in just a moment. Here's the latest. The TikTok bill moving to the Senate after passing in the House by a wide majority. The app facing a US ban unless its parent company ByteDance divests the platform. Brian Weaser of Madison & Wall estimating a ban would leave as much as $8 billion in ad revenue looking for a new home. He writes this: even if digital advertising continues its gradual deceleration towards industry-level growth rates in the coming years, next year could turn out to be a very good one for most digital sellers if a ban took effect. Brian, I'm pleased to say, is with us around the table. Brian, we've got to dance with a lot of what-ifs in the next 5 minutes or so forgive me. Because basically, we have no idea. If it gets to the Senate, if it passes the Senate, what happens next, all the legal challenges, etc. Can we just start here? Potential buyers, if they did divest this, do we know who they would be?
I can't actually imagine anyone realistically buying it. The only one big enough that doesn't have an antitrust problem potentially would be Microsoft, maybe. And even they have a big advertising business to start with. I think the most realistic scenario is if this passes, then we get to a situation where either China says, no, we're not going to let that happen. Or they do an IPO. They literally split off and independently operate. And I think those are the only two plausible scenarios. Pulling out of the US is a very realistic situation.
Isn't it funny, though, the language you just used, I want to pick up on it because I think it's deliberate and there's a meaning in there. You say China won't allow it, but ByteDance says they're not controlled by China.
Right, but the actual algorithms, the actual intellectual property, from everything I've read, is in fact controlled by Chinese governmental supporting entities. They need approvals to be able to do it.
Which is the reason why I think a lot of people are seeing it as basically a proxy war between the U.S. and China and questions around media dominance. I find it interesting about what Lindsey Graham said about a conservative buyer. Because to me, why don't we regulate social media platforms like media, like news outlets, if we're basically saying that the algorithm is going to determine whether it has a conservative or a liberal bent?
Yeah, well, I mean, I think the logic of this was always when it came to broadcast radio waves, right? The public environment, whatever that, could be regulated by the government. You could say foreign owners cannot own broadcast outlets, but foreigners could always own print, right? They could own, there are media assets they could own. I think the bigger issue, though, is that is there a national security ground? Is there a reasonable basis for this? And I mean, that's why this isn't just a First Amendment issue.
Well, that's the thing. Rupert Murdoch became a U.S. citizen so he can take over a U.S. cable network. I mean, well, and also beyond that, also just the regular, not just cable, but also Wall Street Journal, et cetera. Can you see someone outside of the United States buying this?
The problem is there's no one big enough, right? And so it makes way more sense to think of TikTok as a standalone entity, and maybe there's a way to think about them licensing whatever intellectual property they need, or possibly just completely severing from any Beijing-based operations. But it's really hard to imagine that because it's so integral to what they do, right? The whole special sauce of the algorithm is developed by engineers in Beijing. So how do you really separate that? It's like separating the Ferrari engine from the Ferrari car.
But this goes back to what we heard from Brendan Carr yesterday, the FCC commissioner. It's not the content, it's the conduct.
Yep.
And if that's the case, then why would a First Amendment hold up in court? Why would that argument hold up?
I agree. I don't think it does hold up in court.
Let's get to your world, ad spend. Who benefits from this?
Well, it really depends on who takes advantage of the situation. Meaning, if there is, call it $8 billion in the U.S. alone, that would suddenly have to find a new home. Well, what I think would happen is the creators that make a lot of content that drives so much of the usage, they will look for new homes firstly. And so what really matters is, does a Snap, does an Instagram inside of Meta, does even a Reddit, do they start creating new creator deals to offer make it attractive for other creators to spend more time with those platforms? That will drive the money.
What's special about the creator deals at TikTok? What's unique about them?
It's just, who do you produce content for first, right? Who do you prioritize? If you're a creator, you make content on TikTok, you're doing it to the exclusion sometimes of doing it for Instagram or doing it for someone else. In the case of, say, YouTube, sometimes they have exclusive deals, right? In the case of a lot of platforms, they can have exclusive deals. That will drive who wins. So Snap could all of a sudden double its size if they all of a sudden said, here's $1 billion creator fund.
Are advertisers talking with their feet yet?
No.
In sort of anticipation of some sort of transaction?
I don't think that's happening at all. This has all happened too soon for the advertising industry to react, so firstly. But no, I mean, there's no reason why they would pull their money yet.
And there's no reason why they would stay away from the platform because of concerns over national security or other things, correct?
No.
Well, why too soon? I mean, I wrote about this last year, and before that, people have been writing about it since 2022, 2021.
how is this too soon for advertisers?
Too soon in the sense of this legislation going through. Obviously blindsiding TikTok, but you have to think about advertisers allocating their budgets over much longer time horizons. I mean, months, most realistically. But the reality is that, okay, so there's a national security concern. Most advertisers say, and that's my problem, why? Now, we could argue they should. But that's not how they act.
Can we just get to the tensions between the US and China? Obviously, many of these social media platforms in the United States not operating in China, but China is still a source of revenue for them. There's a lot of ad buying going on. Is that breaking down? Is that under threat at all?
Not yet, and this is a big issue we've talked about before, right? This is around 10% or more of Meta's revenue comes from China, right? This is still not fully appreciated. And it's not just Timo Shin. This is way broader than this. I've been on this for a decade. It's been growing. It's been bigger and bigger. It's been distorting a lot of the growth rates.
Even though they're not there.
Correct. Amazon also is probably seeing a similar amount of revenue from Chinese manufacturers spending money on advertising in markets outside of China. It's a big business.
This is Pete Scheer's point about made in China and wanting to export all these goods. They want to advertise around the world. And where do they want to advertise? Where the eyeballs are. So it's sort of, does that get threatened, or ultimately does money win out in the bottom line?
Cross-border trade is a big part of this, right? So how does a Chinese government react? And again, let's not even get, or we can get into what happens if Trump's 60% tariffs are a thing.
Well, we don't have time this morning, Brian, but next time we can spend 10 minutes on it, maybe even longer. Brian, it's good to see you. Brian Weezer there of Madison and Wool. You can't sell BYD. You're not going to do the BYD commercials on Meta anymore, if there are any.
Exactly. And whether China will allow it, because does money win out there as much as it does in the US?
Yep. Economic data about 1 hour away, live from New York City. This is Bloomberg. Stocks are higher by about a third of 1% on the S&P 500, rallying here on the Nasdaq as well after pulling back from all-time highs in yesterday's session, positive by 0.4% on the Nasdaq 100. Monday, Tuesday, Wednesday, starting the week with yields up every single day this week, with the exception of this morning. Let's switch up the board and get to the bond market. 2-year, 462.39, down about a basis point this morning. Started life this week, Lisa, in the 440s. On the 2-year, going into economic data through the week.
This is where the repricing has happened after CPI, right? People are slowly pushing back rate cuts, but it hasn't been dramatic. No one's basically freaking out and saying the sky is falling and yields have to shoot higher, the Fed has to hike rates. No one's saying anything particularly dramatic. It's just sort of, incrementally, things are good, so they won't cut as soon, and it's not going to be that big of a deal.
And that hasn't been at the expense of the equity market,
correct,
which is not where we thought we would be a few months out. A few months ago, looking out 2 months out.
It hasn't come at the expense of the equity market, and it hasn't come at the expense either of the credit markets of all types, despite some of the speculation that rates for higher for longer would lead to some sort of default wave. No one seems to care.
Spreads have been super tight. We'll talk about credit a little bit later this morning. Super tight even with tons of supply coming into the market to start 2024. We're talking about possibly record numbers. Under surveillance this morning, let's get to the top stories. A little under an hour away from a slew of US economic data with PPI retail sales and jobless claims due out at 8:30 Eastern. PPI particularly important as the last inflation read before the Fed meeting next week. A range of views on the street. Citi, Mizuho, B of A expecting a hotter read of 0.4% month on month. JP Morgan's David Kelly at the other end expecting a print of 0.1%. The split between JP Morgan Asset Management and Mizuho pretty revealing after CPI earlier this week.
I'm just waiting for the cookies to cool. We're just sitting around waiting for them to maybe get to a place where we can eat them. Look, if you missed it, go watch it. But to me, I'm just thinking around what will be enough to spur some sort of discomfort in this market, right? Will there be a level of inflation that makes people rethink how long the Fed really has to hold rates and maybe bring Torsten Slok's view a little bit more into the fore of potentially no rate cuts this year?
It's going to happen incrementally. We started the year with a big spread between the market and the Federal Reserve. We've closed that spread with the market coming towards the Federal Reserve. The Fed's going to reconvene next week. They'll plot their dots. They'll come up with a new median. Basically, most people assume it's going to look like the median that we got back in December. But it only takes a couple of policymakers on the FOMC for that 3 cuts this year to come down to 2. It wouldn't take a lot.
But you know what was interesting? People thought they were trying to be hawkish in some of their prognostications by only saying 3 cuts. And everyone said, we don't believe you. And now I wonder if them just saying, no, we were serious is enough for the market to say, wait a second. We have to rethink this. I mean, honestly, so what people take away, the messaging, the tea leaves, the sort of game theory with the Fed and the markets is endlessly fascinating.
Do you want some political theatre? Here it is. Donald Trump holding meetings with potential cabinet picks, considering billionaire John Paulson as a possible option for Treasury Secretary if he wins a second term in the White House. Other names in the mix include former US Trade Representative Robert Lighthizer, billionaire Jeff Yass. According to Bloomberg's reporting, Trump publicly floating the possibility of Paulson serving after his win in New Hampshire in January, but a campaign spokesperson denied any discussions have taken place. Drip feed, drip, drip, drip through the next several months on this front.
Well, when it comes to John Paulson at this event at New Hampshire, Trump said he was a money machine. Guy makes money anywhere he goes. So, maybe we'll put him at Treasury. What I find interesting about our reporting is Jeff Yass, because it comes at a time that Trump has seemingly flip-flopped when it comes to TikTok. Jeff Yass is a huge Republican donor. This is Club for Growth kind of style. And he has billions of dollars invested in TikTok. Maybe this is the man he's floating to run the Treasury? Timing is interesting.
We'll see. Why won't Steve Mnuchin have another run at it?
He's dealing with the New York Bank.
You're done with this, aren't you, already?
I have no interest in the theater. Like, tell me who you actually want to nominate and who you actually want to have a policy, and I will pay attention. Line it up like Bachelor, not interested.
Until then, no interest at all.
I'll track it, but
there's a New Yorker cartoon yesterday that is two women, or I don't know, someone was underneath a blanket sitting on a couch. One is really grilled to the TV about the election. That would be me. And the other person is under a blanket and says, "Shall I take the blanket off when it's over?"
Shouldn't assume it's a woman, Annmarie. That's rude. A bill that would lead to a possible ban of TikTok.
Really?
Gathering momentum. Passing a vote in the House
Lisa in mind.
and heading to the Senate. China calling on the US to stop, quote, unreasonably suppressing the app. But in an exclusive interview with Bloomberg's Stephen Engel, the US ambassador to China, Nicholas Burns, not backing down.
We see it this way. Technology is in many ways now at the heart of the competition between the United States and China, whether it's commercial technology, TikTok, for instance, or whether it's technology that can be transformed into military technology used to compete against us. And President Biden and our administration have been very clear. We're not going to allow the export of American technology to China that would compromise our national security.
The president has thrown his support behind the bill, while rival Donald Trump has suggested it shouldn't be banned. National security has come up repeatedly in the last 24 hours. Lisa's been talking about it. We all have. The fact that yesterday it was TikTok, this morning it's US Steel, and in the future it may well be Chinese EVs.
Well, yes, and it's also come up, Jonathan, where you're deciding between national security or climate when it comes up with this administration putting a stop to some of the permits when it comes to LNG. When it comes to national security concerns, though, a lot of lawmakers are saying, Alexandria Ocasio-Cortez, that this wasn't outlined to the public. I really struggle with that. Avril Haines, the FBI director, the latest global report on national security concerns, all named TikTok. And if that's not worse enough, go back to December of 2022. The executives at ByteDance and TikTok even admitted that some of their employees at ByteDance actually tracked the IP addresses of users, including journalists who were critical of TikTok.
The we need more time argument is a little bit flaky, let's put it that way. Let's turn to credit. A rally in corporate debt gaining momentum despite fears of sticky inflation. Spreads on US high-yield bonds falling to their lowest since January 2022, even with markets pushing back rate cut expectations. Blue Owl is one of the beneficiaries of the credit boom, seeing its shares soar more than 70% over the last year. Mark Lipschutz, the co-CEO of Blue Owl, joins us now for more. Mark, good morning to you.
Good morning. Great to be here.
Let's talk about what's happening in the world of credit. So we had the rate shock last year, lasted about 5 minutes. Some banks failed. We moved on really quickly. Started this year by thinking about commercial real estate, CRE, who's going to be next? Are we going to have this credit stress? Of the 350 portfolio companies that you're across, any distress whatsoever right now?
The portfolio is strong. The economy read through our portfolio looks quite positive. Certainly, wind back a year, and I imagine if we were all sitting here, I had the privilege of having this conversation with you a year ago, I think we'd probably all be talking about what type of recession would we be in right about now. And we're not. You know, I look across those 350 companies, and you look last quarter, our companies on average grew 15%, their EBITDA. So that is, now these are very selected. Obviously, our job is to find great companies and to make loans to really strong businesses that have a lot of potential, a lot of growth. And where we can, therefore, have a lot of cushion in our loans. But nonetheless, if our portfolio is growing 15%, we are not in a recession nor on the edge of it. And we don't see the normal indicators yet that would suggest a meaningfully weakening economy.
Do you find that your portfolio companies can handle paying 10, 12, 14% interest rates and survive and thrive? Are the higher yields that we're talking about not restrictive based on the growth that they're projecting?
Cutting through it all, they're doing fine in that context. I think what we now know from what we didn't know a year ago was this speculative question of, with rates rising to levels, of course, we hadn't seen in many people's working lives. They hadn't even experienced interest rates that had like a positive number to them. But in any case, at the end of the day, what we now know is we have a full year of those rates have run through the P&Ls of these companies. And I mean, of course, by definition, there's going to be an incremental company that will struggle more in a higher rate environment. But writ large, no, that has been absorbed by the system and quite successfully. We see it. We're not seeing these waves of changes or even the precursors to them, like asking for lots of amendments or meaningful changes in, hey, can I pay in more debt? Can I pick my interest instead of paying in cash? So the indicators that are not even just we would suggest an issue, kind of have to predate an issue, just aren't there in any meaningful degree yet.
Which is fascinating to me because we talk about, is it restrictive, and then have companies actually felt this? You're talking about floating rate note loans, so you're talking about companies that actually are handling higher benchmark rates now, not necessarily waiting to refinance. How has it affected the demand, given the fact that companies have seemed reluctant to borrow to fuel growth, given the higher rates?
So indeed, look, our specialty is senior secured floating rate debt. So to your point, this environment has been very good for us, good for our investors. It's raised on a quite quick basis the returns people earn. Of course, that's the point, to be inflation protected in our kind of product. So companies have absorbed that pretty successfully. People are borrowing capital. At the end of the day, again, of course, supply and demand, we all know more expensive capital means people are going to use perhaps less of it. But in the world of private equity in particular, in buying a company, and I started in private equity myself back in 1995, wasn't even called private equity then. And at the end of the day, that cost of capital, it's a bit of a calculation, right? It's how much you can pay for that company. Of course, it reduces the value you can pay for an enterprise, but it really isn't prohibitive to conducting activity. What you really need is an environment where people have a common set of expectations. It's really more about the gap between buyer and seller in terms of their expectations than it is the absolute numbers.
Was it easy back in the 90s compared to now? Was there less competition? How different was it?
Well, it was a lot different, that is for sure, and there was certainly a lot less competition. If you look back to 1995, when I was lucky enough to join KKR, there were two large private equity firms, LBO firms, as called then, at the time, Forsman Little and KKR. The world now, we're talking thousands and trillions of dollars of capital.
Everyone wants a piece of this, and I think there's a worry that maybe it just ends up with people chasing the same deals, they're sloppy deals, and maybe the traditional lenders get squeezed out. Is that how you see things at all?
So the opportunity, by virtue of that evolution of the market, trillions of dollars of private equity, what we saw at Blue Owl was the opportunity to create the financing source to meet that need. Now, this is a very young industry comparatively. When we talk about that very point, thousands of private equity firms, amongst the folks that focus on the large area, we focus on the very largest financings, very largest companies. There's just a few of us. So it's a very young industry by that measure, and I think, therefore, a lot of opportunities ahead.
To his point, though, a lot of people would argue that we know what's going on with some of the public markets because basically you've seen the best and the brightest kind of weeded out and others kind of fall out of bed and maybe gone to the private markets. There's sort of this question of, is there some behavior that could lead to higher default rates that could be somewhat masked by the lack of transparency? Do you buy into that? Do you see colleagues that are operating with, say, maybe less or lower standards than yourself?
I believe that the private market has fundamentally added a stabilizing influence in total. Now, of course, again, you're going to have a dispersion of different participants. Some will do better than others. We're intensely focused on credit. That has been where we have lived. We've done about $90 billion in loans, and our running loss rate has been 6 basis points. So there really is a durability, but more important for the markets writ large, having a steady source of capital through ups and downs. During the pandemic, we were still providing capital. During the run on the regional banks, we were providing capital. When inflation was surging, we were still providing capital. So a healthy system is not one where private markets take over from the public markets, but it is one where you have a large, vibrant private market, alongside a large, vibrant public market. That is a better economic platform.
You inked a pretty big deal last fall with Mubadala. Do you see more interest from some of these sovereign wealth firms, particularly in the Middle East?
We do. You know, the private lending, direct lending was adopted, I'd say, generally speaking, earlier by U.S. institutions. And part of that, I think, is just the maturation to a degree from really 10 years ago, this flavor of direct lending, the lender of first choice, as opposed to lender of last resort, really didn't exist. So this is kind of a 10-year industry in that regard. And now we're seeing an increasing interest with non-U.S. investors. Part of it, I think, is now appreciating the durability. It's a so to speak, a safe haven. Where do you want to be when times are uncertain? You talked earlier about the dispersion of views. I think where you want to be is senior, secured, floating rate. So I think that the non-U.S. investors are appreciating that being a core holding. And at the same time, just look at the absolute returns. When you can generate double-digit returns, taking that very senior position, that very moderated risk, that absolute level of return starts to really resonate for people in non-U.S. markets as well.
Can I finish with a terrible question? Is there evidence whatsoever, any at all, that this Fed is sufficiently restrictive, based on what you see in your world specifically?
So here is what we see in our world. Inflation's a sticky animal. We saw it starting a year ago, and there's plenty of things. We're not macro prognosticators, but,
not at all,
but 350 companies looking bottom up, we continue to see inflation be sticky. There are offsets for sure. Look, shipping costs have come down dramatically. We have a consumer products company that was paying $20,000 a container. Now they're paying $3,500. But wages are sticky. Wages are still rising. So we are not through the teeth of this inflationary challenge. We're through the worst of it, but we're not done with it.
This was probably better to get your answer than ask another economist this morning. Mark, it's good to see you. Thank you, sir. Mark Lipschultz there of Blue Owl Capital. I think the answer, Bramo, I think you heard the same one, right?
I mean, basically, no, because if we're looking at companies that can handle higher borrowing costs and are still hiring and still expanding, where's the restrictiveness?
It's pretty revealing. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The world's largest assembler of iPhones, Hon Hai, reporting a 33% jump in profit in the fourth quarter. But it wasn't iPhones powering that growth. Hon Hai saying they're seeing very strong demand from clients for AI hardware. The Taiwanese company also giving a bullish forecast for the year. Former CNN anchor Don Lemon said Elon Musk canceled their partnership for a new show on X. Lemon said he was informed of the decision just hours after he interviewed Musk. That interview is still set to air as the first episode of the Don Lemon Show next week, which Lemon says will now continue on other platforms. X had unveiled the show earlier this year as part of a new slate of video programming. And SpaceX is set to take another step forward in its Starship program. The window for the third major test flight for the massive rocket opens at 8 a.m. Eastern. Starship is the largest and most powerful rocket ever developed and has an ultimate goal of taking humans to Mars. The last two tests ended with explosions, with this launch hoping to approach orbit. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, Houthi attacks continuing to weigh on global shippers.
The Houthis have continued to launch these reckless attacks with no regard for the well-being of innocent civilians who are transiting through the Red Sea. And now they have unfortunately and tragically killed innocent civilians.
That story just around the corner. Stocks doing okay, up a third of 1%. Data drops in about 42 minutes from now. Retail sales, PPI, jobless claims. You know the drill this morning. Yields unchanged on a 10-year, 419.38. Under surveillance this morning, Houthi attacks continuing to weigh on global shippers.
The Houthis have continued to launch these reckless attacks with no regard for the well-being of innocent civilians who are transiting through the Red Sea. And now they have unfortunately and tragically killed innocent civilians. And so the United States will continue to hold the Houthis accountable for their attacks.
It's the latest this morning. Shares of Hapag-Lloyd lower in Germany after the shipping giant reported a decrease in earnings and warned of a further decrease in 2024 on a, quote, volatile and challenging economic and political environment, especially in view of the current situation around the Red Sea. Rolf Habben-Jansen, the CEO of Hapag-Lloyd, joins us now for more. Rolf, great to catch up with you, sir. I want to talk about freight rates. When freight rates first started picking up earlier this year on the back of this story, there was a sense from some people that maybe that was temporary. Do you see that as the new normal now, and ultimately, are they going higher?
I think we saw an initial reaction was especially spot rates went up a lot because that's a combination of everybody then trying to book things quickly. We were running up to Chinese New Year and a lot of uncertainty. I think right now we see that the services are stabilizing, which means also that the market is getting calmer. And as a consequence of that, I think we also see spot rates in particular coming down. Just how much time and investment has gone into finding alternative routes? Are you considering more land routes? Are they viable given the increase in rates that you've seen? I mean, we have opened up a number of new land routes. And we've also taken on some additional ships. And of course, we've also had to buy a lot of additional containers because as all the voyages have become longer, we in reality also need more boxes to transport the same amount of cargo.
Rolf, how easy is it to pass along the extra costs associated with this to the shippers, to the consumers, to the companies that want to ship?
I think we see by and large that these costs are being passed on, and I think that's also reasonable. I mean, if you compare the situation now with what we had at COVID, there, of course, rates exploded. Today, you have a different situation because there was probably some spare capacity in the industry when this crisis hit us, and that has certainly helped us to keep global supply chains going and also to keep the increase in cost within reason.
So if there isn't any pushback, why are some of the profitabilities coming down? Just simply because if you can pass it along, are people shipping less? Are they looking to different routes that are shorter?
I think right now you are still looking at the results that come out on companies in the fourth quarter, where we had exceptionally low rates that were way below cost. That's also why a lot of companies posted losses. I think you will see a recovery in freight rates when you start looking at the first and second quarter. The question is, of course, what's going to happen once the situation around the Red Sea normalizes.
I want to talk about the situation in the Red Sea. The United States seems to be in a cycle of defense, not deterrence when it comes to their posture. Are you seeing any signs of deterrence from the United States or the UK or others when it comes to the Houthis?
Well, first of all, let me say that we really welcome all the efforts that are being undertaken by the U.S. and their allies to try and stabilize that situation. But of course, it's very difficult because it's a fairly large area that you need to defend. And so far, we have seen that the attacks of the Houthis continue. And that also means that we will then decide we have no other choice than to keep our people safe, even if that means that, some of the supply chains are then 7 or 10 days longer.
Well, what are governments telling you about securing the Red Sea? Do you have a timeline of when you think you could start using that route again?
I think there are many different opinions on when that is going to happen. I think we hope that we're going to be able to go back through in a couple of months. But I know there are also people that think that it may last quite a lot longer.
Rolf, thank you, sir, for the update. We appreciate it. It's an important story, has been for the last few months. Rolf Habben-Jansen there, the Hapag-Lloyd CEO. Looking at this, AMH, we thought we could deal with this quickly. We didn't. We can talk about the inability of allies of the United States to basically reopen this important trade channel. It hasn't happened. Freight rates have gone up. We thought that might be temporary. Based on that conversation, that doesn't sound temporary at all.
It doesn't, and what they're going to have to do is put more money into those vessels, and those vessels take a lot longer in the direction of travel where they're going around the Horn of Africa, the gasoline. And then he also said the cost this is now going to those businesses is now trickling down to the consumer. This is what we heard from the UK Chamber of Commerce as well.
The fact that they're able to pass along the costs, though, gives me sort of this real question, which is basically how much does that affect prices? Is this just a European issue? Then does that basically take the onus off the U.S. to really defend? Is that part of the reason why there isn't more aggressive action in the Red Sea? But then also from their earnings perspective, why wouldn't it be a good time then? Because it's kind of going back to freight rates being higher and people accepting it.
What did David Rosenberg say of Rosenberg Research earlier this week? He said there is CPI world and then there's the real world. The real world around this table in the last 10 minutes is a very different real world to the world we were talking to him about. We've just spoken to someone across 350 portfolio companies who just basically said that rates aren't hurting them and inflation is sticky. And that conversation, and I know, and you can use the I word for that conversation, of course it's idiosyncratic, but it speaks to a broader story as well. You hear sticky inflation right there too.
And you hear that people are able to absorb it. That's the key. It's not difficult for them to pass it along to the companies because they're willing to pay it because they need the goods, because there's the demand for it. And that's the ultimate underlying point.
Besides the security concerns in the Red Sea and the Gulf of Aden, if inflation is still what is hurting this administration and this campaign in their polls, you'd think they would take a more aggressive posture when it comes to deterrence of the Houthis, not what we've really seen, which is pretty much just a defensive one.
That's the latest in the Middle East. I just want to set the stage with you for the rest of this morning. So equities at the moment on the S&P 500 positive by, let's call it 1/3%. In the bond market at the front end, Monday, Tuesday, Wednesday yields up. This morning, a little bit lower, 463 on a 2-year, on a 10-year, 419. As we go into a big hour ahead, Lisa, a lot of economic data, PPI, retail sales and jobless claims. Take your pick, really, but for Julia Coronado a little bit earlier, there's pieces of PPI that go into PCE that could shape the conversation at the Federal Reserve a week away.
Airplane tickets. It all comes down to airplane tickets. I mean, there's some other components too here, but when we talk about the I word, let's talk about idiosyncratic. There are so many interesting stories, but they're all pointing in the same direction. The idiosyncratic story of airplane tickets, the idea that they're going up maybe because of Boeing not shipping as many of their planes, the idea that you're getting some of the increase in baseline gas costs. You know, you just have to wonder, when does that actually start to trickle out?
Coming up, Anastasia Anamoso of iCapital. She's going to be talking about some of these themes. Wells Fargo economist Jay Bryson, Bloomberg's Michael Shepard, and a conversation you do not want to miss. Colin Langan of Wells Fargo making some headlines in the last 24 hours, downgrading Tesla, a growth company with no growth. Lisa, difficult day yesterday for the stock. Difficult again this morning.
Difficult year for the stock, and how long can that continue?
Live from New York City, the third hour of Bloomberg Surveillance. Up next.
Look at the bigger picture. The broader trends in inflation and core are moving down.
Most people are not anticipating a re-hiking cycle or a re-acceleration in inflation.
Ultimately, after what we went through, I'm just happy that tightening's over.
There's plenty of time to see how the balance between growth and inflation plays out.
The economy is on a cooling path, but it's a very gradual path. There have been a lot of tailwinds for the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The most important hour of this morning begins right now. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, your equity market on the S&P 500. Positive 1/3%. We are 30 minutes away, call it 29, from PPI, jobless claims and retail sales. The last big slate of data, Bramo, going into the Fed next week.
Will it change anything? Does it have to change anything for the Federal Reserve? Ultimately, I want to see if the market cares, how much people start to realize, wait a second, there's something that's greater and stronger under the hood here than perhaps we're pricing in.
The risk event, maybe there's two. They're going to have a conversation about a balance sheet, doing something about QT. That was flagged at the last meeting by Chairman Powell. I think the risk event for a lot of economists on Wall Street is whether those three dots, those three cuts implied by the median dot at the Federal Reserve drops down to 2. We go from 3 to 2, and which would drag the market maybe in the direction this market didn't want to go in at the start of the year.
That, and if Jay Powell comes out and doesn't sound quite as rosy about everything, maybe seems concerned about the fact that financial conditions have eased so much. Ultimately, a lot of people say the reason why equity markets just don't care about inflation staying sticky is because they know the Fed wants to cut, the Fed will cut, and therefore it will keep this party going.
And then what happens when Jay Powell comes out, potentially, if this is sticky, and then not just down to 3 to 2, but if he has to push it back in the timeline. And then I'm interested in that, because then what does that mean for November? Does he cut before the election? Does he wait till potentially after?
Let's set up the next 60 minutes. That's not the only story we'll be talking about. We'll be talking about Tesla as well. That is down by 1.4% in the pre-market. Yesterday, it was a whole lot lower. There was a downgrade from an analyst over at Wells Fargo. We'll be catching up with him in about 45 minutes' time. Off the back of this story, Lisa, that ultimately there is no growth. A growth company with no growth. How do you value that company if that's the backdrop?
a lot lower than you did yesterday and the day before and a year before, which is exactly what we've seen with this basically being kicked out of the Mag 7, right? I mean, essentially, it's been kicked out of the club this year and last year. And now we're looking at a question of, is this just a pause or is this a shift where people have to reassess the profitability of the electric vehicle transition?
This is not just low growth. I'm going through the note again. No growth this year, Annmarie, negative volume growth next year.
Well, the issue as well is just the broader EV market, and that's worldwide. Sales are down. And then you look at China, where Tesla wants to be selling. They have steep competition when it comes to BYD. BYD's the homegrown viral in China sells a model price for less than $10,000. How do you compete with that?
This has been the story of the last few months. This is not new. This is where the market has been going, towards hybrids. Toyota absolutely flying. Pure EVs, Tesla suffering. If this is where the market is now, I want to think about the next stage of this. Is this where the market's going to be for the next several years? Southside's playing catch up, it's caught up. This is where we are. We're all on the same page. This is consensus now. This is the market. Hybrids. Is that where it's going to be in the next couple of years?
A lot of people say it's deferred, it's not delayed, not deferred, right? This idea that we're going to get there eventually. But it goes to your question, how do we price this in? I've never known how you price Tesla. Is it a tech company? Is it a car company? And ultimately, there are some key questions about how you can sort of effectuate the AI dream through the car if people aren't buying the car. So this is ultimately kind of a key question going forward that I am not going to weigh in on.
And then you've got the cult of Elon premium in the stock as well.
And you can send your hate mail to my inbox for mentioning his name.
Does that go into the junk? Is that
No,
where that goes?
I like to read all of it. I read all of the hate mail.
You like to suffer, don't you?
I do.
That's what it's about.
This goes deep.
Tesla, slightly negative in the pre-market. Coming up later, Colin Langan of Wells Fargo. Looking forward to that. Equity futures right now on the S&P 500, positive by a third of 1% on the S&P. In the bond market, shaping up as follows. A 10-year yield just about unchanged, 4.1919. Coming up this hour, we'll catch up with iCapital's Anastasia Amoroso on why she thinks markets are in a sweet spot. Bloomberg's Michael Shepard on Biden's pushback against the US steel takeover. And Jay Bryson of Wells Fargo on his June rate cut call and whether that is under threat. We begin with our top story. Stocks pausing ahead of the final inflation report before next week's Fed decision. iCapital's Anastasia Amoroso saying this. Since January, we have largely seen economic data come in well above expectations, namely jobs and inflation data, supporting the view that the economy could be experiencing a re-acceleration or no landing. Despite the fears of overheating, we have seen data start to cool from the torrid pace at the start of the year, indicating that the economy may be operating in a sweet spot. Anastasia joins us now for more. Anastasia, good morning. It's great to see you, as always.
Good morning.
Is this why you're still constructive on this equity market?
That's right. I mean, the sweet spot is exactly how I characterize these equity markets because, you know, what happens, John, when you have good economic data, the markets inevitably cheer that because good economic data is good for earnings, is good for revenues, is good for profit margins. And one of the things that we have seen this year, as the economy is stable and accelerating, we've also seen the earnings growth expectations are also stable and actually firmed up a little bit. So that's why I think the markets have been able to push back the rate cuts and still move higher. But then on the flip side, you know, if we do get bad economic data, well, guess what? The consensus is immediately going to jump in and say, well, that means the Fed has to cut rates. So whether it's economic growth, whether it's rate cuts, but that's to me why the market is in a sweet spot.
So good news, bad news, good news.
Exactly. A lot of good news in there. Yes.
Basically, and equities keep on ripping. Can you talk to me about the part of the stock market you still like? Is it still the big leaders, the winners, big tech, or are you shifting elsewhere?
Definitely like some of the big leaders. And during the break, we were talking about, or I guess before the segment, we were talking about how maybe Tesla's out of the Magnificent Seven. But, you know, you definitely do like parts of the Magnificent Seven that are related to artificial intelligence and are actually delivering on that. But I think the other interesting story, John, is that there is a broadening out that is happening in the market. And I do like the cyclical straight. So one thing that stands out in particular is industrials. Maybe very quietly, but under the surface, you are seeing a lot of firming in the manufacturing space. You saw a big uptick in new orders for ISM manufacturing. We gave a little bit of that back last month. But when I look at the global manufacturing index, it is back above 50. It is the strongest level that we've seen in about a year and a half. And it's not just one country. You know, it's China, it's India, it's Brazil, and it's a lot of other countries that are participating in this manufacturing uptick. So that's why industrials have been strong so far year to date. And when you look at hedge fund flows, they are going into industrials. So I like sticking with AI. I like sticking with some of the tech leaders, but I do think that it is also time to add some of the cyclicality to the market as well.
When I go home today, I'm going to look up Google searches of sweet spot and Goldilocks and see just how much it's surged. How long can we stay in this sort of everything is awesome, buy everything, ignore the data, it's all good?
Yeah, I mean, if the Fed starts to materially push back on rate cuts and, if it looks like we may not be getting rate cuts this year, I think that's when you start to have to worry because, Lisa, you'll probably remember the last time I joined you in December, I talked about the size of the debt pile, whether it's the U.S. government debt or the corporate debt. And, it's fine if it has to be refinanced at lower interest rates as the year progresses. But if it still has to be refinanced at 5.5% as the year progresses, I do think that debt burden starts to build and accumulate. So I don't think we get to that. I think the Fed ultimately does cut before that. But I guess that would be the pivot point to where I'd worry.
Which is the reason why I think a lot of people are saying, out there, we can worry about it later because it's probably not going to come to pass. When you talk to investors all around the world, when you travel in the U.S., are people concerned about downside risk? Or are they concerned, to Mandy Zhu's point, of not getting the upside risk that could be where volatility is headed?
Yeah. Well, it's interesting. There are two ways that I have to answer the question. I was at a presentation earlier in California this week, and I did actually do a survey of the room. It was a sizable room. And, most people were bullish. Most people kind of agreed with the bullish consensus. And the question that I posed, consensus for analysts out there is 5,000. That's the target for the end of the year. So the survey of the room was definitely much more constructive than that. So I think most people are participating in this market. But on the flip side, we do quite a bit of structured investments for our clients. And a lot of our structured investment advisors are asking for additional protection on some of the structured investments they're doing, meaning they're asking for not just a 10% downside buffer, but maybe something more than that. So I think it really depends on what, how you've participated or not in the market last year. If you were sitting largely in cash, then you are probably playing catch up right now. But if you did really well in the tech trade, you might actually be looking to de-risk some of that by adding some of those additional buffers.
Which is kind of what we've seen recently. We've seen the NASDAQ 100 underperform some of the equal weight, et cetera. And I'm just wondering, do you buy this idea, well, we have gotten a little frothy, we like the trade long term, but it could pull back 6%? I mean, that's basically what we've been hearing from every analyst about the tech
NASDAQ trade.
Yeah, the NASDAQ trade. Is that basically where you are too?
Yeah, yeah, I think I'd have to agree with the consensus there. Look, if you look at every single technical indicator, depending on the stock, we have seen some overstretched positioning there. We've seen some overstretched momentum. So you'll probably have a catalyst to consolidate some of that. But, if you look at the AI trade long term, this is a multi-year opportunity. This is close to a $1 trillion total addressable market by 2026 that I think most analysts are still modeling conservatively. The reason why, and I'm using NVIDIA purely as an example, but the reason why, NVIDIA has been able to, top estimates because analysts are only penciling in what they can see for the next couple of quarters, but they're not really modeling in the true $1 trillion TAM into 2026. But as that comes into view, and the analysts and companies deliver and the analysts kind of reset those expectations, that's what gives you the upside. So I would say even if you look at some of the price targets for some of the tech stocks today, maybe they're a little bit more modest today because stocks have rallied, but that's not a ceiling. That's just sort of a starting point.
In your latest note, you actually start looking at the election and you say the market already is pricing in a winner. Who and why?
Yeah, I mean, it's actually clear from market data that the market is pricing a Republican win. And obviously, if you looked at the polling data, if you look at the predicted odds, for example, the former President Trump does appear to be in the lead. And since October of 2023, you've seen various types of Republican baskets from various banks outperform by a wide margin the Democratic baskets or the Republican underperformers. And, that might have something to do. I think part of it has to do with the election odds, but I also do think the composition of the baskets are more cyclical for a Republican basket. You're looking at things like financials, things like industrials, things like energy and materials. And so, it does have a high correlation with the S&P. But if you look at hedge fund positioning, once again, for example, in the Republican basket, you are seeing longs being added to the Republican longs and the opposite for the Democratic basket.
So do you think that's correlation or causation? What do you think that is?
I think it's a little bit of both. Look, I think the primary reason for why the Republican basket is outperforming is because of that cyclical momentum. So, I think that's more of a correlation. But But I do think that there's a part of the investment community out there that is positioning for election outcomes. And what a great way to position, if that's the outcome that you're trying to position for, which is get the cyclicality in the portfolio, which is sort of right with the momentum of the economy and the market. And it also has the potential to benefit from a Republican win. Now, on the flip side, the Democratic baskets, they're pretty concentrated, and there's a lot of EVs in there. There's a lot of clean energy in there. So, you know, is it purely because of the odds of President Biden not being reelected, or is it really more fundamental and the outlook being more mixed for those?
Really interesting stuff. Anastasia, fantastic as always. Good to see you. Anastasia Amoroso there of iCapital. Just got a note from Citi. Andrew Hoddenhorst, retail sales. Haven't talked about that nearly enough. Lisa, you were touching on it. This is what he's got to say on retail sales this morning. If the control group is expected by us and consensus to increase after a large decline in January and then doesn't, if we're wrong, a second consecutive decline would raise recession concerns. Haven't heard much of that chat at all.
The R word? I mean, we're talking about sweet spot and Goldilocks. This is a question, right? If we start to see people stop buying, it's a big if, and it sort of goes against what we're hearing anecdotally from companies, that could be a real problem, potentially on the downside.
The data, 17 minutes away. Equity futures right now near session highs, up a third of 1%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. A bill aimed at forcing a sale of TikTok is moving forward on Capitol Hill. The House passed the TikTok divestment bill by a vote of 352 to 65. It now heads to the Senate, where its prospects are less clear. Majority Leader Chuck Schumer has only said he'll review the bill, and members, including Republican Rand Paul, have come out against it. While investors await the highly anticipated Reddit IPO, the social media company is giving guidance on its expectations. Bloomberg News has learned Reddit is telling potential investors it expects revenue in 2024 to grow by more than 20% versus the previous year. According to its filing with the SEC in 2023, the company saw revenue come in at just over $800 million. Disney is making a push to find a successor to CEO Bob Iger. The board is focusing on the leaders of 4 different divisions. This happening as Disney is embroiled in a bitter proxy fight with billionaire activist investor Nelson Peltz. Iger's contract runs through the end of 2026. No decision on his successor is expected this year. That's your Bloomberg Brief. John?
Yahara, thank you. Just a quick update on Tesla. UBS price target cut to 165, down from 225. Few reasons for it. Let me share about 3 of them. Revision is driven by slower demand in Western countries, intense competition in China. We now assume very limited Model 2 units in 25, pushing any meaningful volume to start in 2026. We'll pick up on that a little bit later. That stock is down 1.5%. Up next on the program, Biden backing U.S. steel.
We know we have to reshore, and we have to be self-sufficient. We have to be resilient. That doesn't mean we can't have partners, but we need to be able to do things here first.
That conversation up next. Equity futures on the S&P 500 up a third of 1%. Yields unchanged, 419.38. The data about 12 minutes away. Under surveillance this morning, Biden backing U.S. steel.
This is one of those bipartisan things on trade. They fully understand how important manufacturing now is to the United States of America. And if you look at just the challenges that we had during the pandemic, where we couldn't get basic things, virtually every industry that we serve struggled because they couldn't get parts from other parts of the world. So we know we have to reshore, and we have to be self-sufficient. We have to be resilient. That doesn't mean we can't have partners, but we need to be able to do things here first.
It's the latest this morning. President Biden releasing a statement opposing the potential takeover of U.S. steel by Japanese firm Nippon Steel. Biden saying this morning: it is important that we maintain strong American steel companies powered by American steel workers. I told our steel workers I have their backs, and I meant it. U.S. Steel has been an iconic American steel company for more than a century, and it is vital for it to remain an American steel company that is domestically owned and operated. Biden's pushback coming as the campaigns in Rust Belt states for union and blue-collar votes critical for his re-election bid. Bloomberg's Michael Shepard joins us now for more. Shep, national security risk dominating policy efforts in Washington. It was TikTok yesterday, U.S. Steel this morning, Chinese EVs about a week or so ago. Where is this effort ultimately going into November?
Well, it's a great question, Jonathan, because we're seeing various threads all come together. We heard the U.S. Steel CEO talking about the importance of supply lines and supply chains separately when it comes to EVs and TikTok, which we saw the big vote in the House yesterday. There's a question concerning data. All these roads point back to China, though, because, the underlying tensions between the world's largest and second largest economies remain. And the U.S. is concerned about making sure that Americans' data and privacy and national security are protected, and supply chains are too.
Michael, if everything's a national security risk, are we diminishing the meaning of national security?
Well, at a time that we're also seeing Russia making gains on the battlefield in Ukraine and this battle to win the hearts and minds of the global South, everything acquires an additional level of importance. And people are much more fundamentally aware of how all these things fit together, especially after the pandemic, when we saw supply chains pinched and the effects felt here at home. So it may not look like a national security question in the traditional military defense sphere, yet there is an economic security question that's just as important and that hits home here pretty directly when things go sour.
Japan was also worried when the U.S. paused the LNG export approvals. Now Japan is concerned because of what's going on with U.S. Steel. Is this administration putting election politics over its firm allies?
Well, and I'm glad you asked that, Annmarie, because as you know, in a few weeks, the Japanese prime minister will be visiting Washington for a state visit. And this will be an awkward moment for him with the president, because obviously Nippon Steel, an important manufacturer back home for Japan, but they are buying an iconic American firm. Biden used that word in his statement, and I'm glad you were able to show that for viewers. There was so much to unpack in what Biden was saying, because he is addressing U.S. Steel status. Even in a non-election year, this would be a tough deal to get through. If Trump were in office, he has said he would block it immediately. And I think it would be tough for Biden to do even in an off year, because remember, he was born in Pennsylvania. He has ties to this area. U.S. Steel is from Pittsburgh. So for Biden, there is that. Add the election year, and it becomes even harder, especially as Trump and Biden are vying for the union vote and trying to win in these swing states, especially Pennsylvania, but also Michigan and Wisconsin. The three of them make up the so-called.
He was in Wisconsin yesterday. He's going to Michigan today. He's from Pennsylvania. Can he win without the blue wall?
The Democrats maintain that they have several paths to victory. It will be difficult. It will require him to win the other 4 swing states, including Arizona, Georgia, and North Carolina. So this would be a much tougher road to hoe for him if he doesn't prevail in these 3 places. Remember, in 2016, Trump swept them. And then in 2020, Biden turned around and swept those 3.
Hey, Shep, great to hear from you. Michael Shepard, just a busy time down in Washington, D.C. on this front. Lisa, you were the first to identify it this morning. Everything seems to be a national security risk.
I'm actually looking up people who are specialists in national security. I want to talk with them about how this is unprecedented or not.
Are they hiring?
Well, can I please go talk about national security? Because everything's going to become national security. This is really a key question. Does it lose meaning? You asked it well. Does it lose meaning if it's being used for everything, and if it's being conflated with trying to keep business at home and trying to cater to certain union types of interests?
But this is my issue. Everything is national security until it's not. Look at what happened with the LNG permits. They decided to actually lean into climate and electoral politics and not national security. But national security is useful, say, for trying to shore up these supply chains, which, by the way, Nippon Steel only has about 5% of its production in China. I'm not really quite sure what the national security concern is exactly. Election politics play out.
When's the election in November? What day?
November, it's the 5th.
The 5th. So the 6th, That's when everything is no longer a national security risk. Is that what we're saying?
This is my frustration. There are some legitimate questions here. If we can't agree on the facts and the facts are getting conflated with other things, does it muddy the conversation and make it very difficult to parse the fact from the fiction?
Mike McKee wants to talk about the national security risk of retail sales that drop in about 6 minutes' time. He joins us around the table. PPI, retail sales, jobless claims, Mike, all coming up.
I'm shocked listening to you that politics is going on in Washington, D.C. I mean, how amazing.
Shocking.
Well, the politics does play into the retail sales and PPI numbers because, of course, it's all about the economy. I don't know there's a national security interest in any of these data, but catch me for GDP, we'll look at defense spending. But right now we're looking at a strong rebound in PPI is what's forecast, a lot of weather effects in January, and the PPI is expected to stay about unchanged, but it'll be interesting to see the categories that move because of some of this feeds into PCE, which obviously the Fed cares about.
Which pieces of this, Julia Coronado mentioned this a little bit earlier this morning, which pieces of PPI are important for PCE in this Fed?
Portfolio management, we've talked about that on the PCE day, about how much that's added to PCE inflation. Also insurance. And that's an interesting thing because that has come up politically in Washington, is the cost of auto insurance, house insurance, life insurance, everything is going up very, very fast. And people are wondering, you know, what's going on with the insurance companies here and how are they getting away with this?
Our lives are just worth more. I think that's the reason
Well
why.
said, Lisa. That's beautiful.
Thank you.
It's not about being ripped off. We're just more valuable.
100%.
Love that.
Thank you.
My premium's higher than your premium.
Yeah, exactly.
Maybe.
Start talking about that.
You should campaign on that, Bramo.
We just
Your
are all
insurance
worth
is
more.
up. We're all worth more. It's beautiful. Up next on the programme, who are you? PPI, retail sales, jobless claims up next. Jay Bryson of Wells Fargo joining us in a moment. Where's Bramo?
Well, she's coming back.
It's the biggest morning of economic data of the week, going into the Federal Reserve decision just around the corner. Going into this, equity futures right now positive by 1/3 of 1% on the S&P, up by 0.4% on the Nasdaq. Retail sales, jobless claims, PPI data coming right up with Mike McKee. In the bond market, the scores as follows: 2-year, 10-year, 30-year. 2-year, 462, 82. 10-year, just short of 420. With the economic data, here's Mike McKee.
All right, let's take a look at what we got. Retail sales come in a little lighter than anticipated, up 0.6%. They were down 0.8 last month. The expectation was for an 0.8 increase this month. Complete payback, did not get that. Ex-autos, 0.3. Autos did rebound in the month of February. A lot of what happened to retail sales in January was weather-related, economists say. So we may be seeing some rebound pickup here. Retail sales control group is flat after declining in January. That's not as good news as people had expected. The thought was we'd get a 0.4 rise for the month. PPI comes in, the headline, up 0.6. That's double what it was last month, double what was expected, and that is not going to be good news for the Federal Reserve's idea that they want continued good news on inflation. The core rate, if you subtract food, energy, and trade, kind of the super core, up 0.4 after a 0.6 rise the prior month. Year over year, the PCE goes from a 0.9 increase to a 1.6% increase, a fairly large move. The core doesn't move, however, it stays, the super core I gave you, 2.8 from 2.6. The regular core with just food and energy taken out, 2% from 2%. So anyway, we've got some issues there. But if you want to have something good to look at, take a look at jobless claims. They fall to 209,000. Last week's 217,000 revised to 210, and continuing claims fall a lot from the initial report last week, but the initial report last week was overstated. We're at 1,811,000. Last week's 1,906,000 revised down to 1,794,000. So the narrative that it's getting harder to find a job seems to have gone away. along with the narrative that inflation is going to get to 2% very quickly.
As we like to say in jobless claims, Michael McKee, that is the right kind of downside surprise. There is something for everyone in this slate of data at the moment. Equity futures backing away from the highs we were at going into the number. We're just about positive still by 0.1% on the S&P. Up a similar amount on the Nasdaq. In the bond market, one-way traffic, yields up all week. Monday, Tuesday, Wednesday, now Thursday, yields up by another 3 basis points to 466. High of the year in the 470s. We're getting closer. We started the week at about 448. On Monday, opening higher 448.60. So yields up all week off the back of upside surprises. That's the bond market. Here's foreign exchange. Euro weaker, dollar stronger, 109.28. We're negative by 0.2%. Let's go through the data. PPI, upside surprise. Jobless claims, downside surprise. Retail sales, a little bit softer. Lisa, as we were saying, there's something for everyone.
There's something for everyone, but the narrative this week is getting clearer and clearer. Inflation is not going down as quickly as people thought, period, full stop. And that, I think, is what you're seeing priced into certainly Fed futures, where you have this idea now of a 60% chance of a rate cut baked in for the Fed's June meeting. But we can see across the board, the labor market isn't weakening as much as people thought, and inflation isn't going down, and that actually pairs completely with the anecdotal data as well.
Key risk, and well said, Alan Zettner, Morgan Stanley. It would take just 2 participants to change from 3 cuts to 2 for the median dot next week to move to a total of 2 cuts in 2024, underscoring the risk tilting towards fewer rather than greater cuts in 2024. And Lisa, I think that puts a bow on it, doesn't it? That's the concluding point.
There is no way that the Fed can say we have gotten more comfort from these numbers, that we are getting closer to our 2% goal. How can they message this in any way, shape, or form? If they message the opposite, this gets us further away, that could cause a real reaction in markets.
So, Mike, we started the week looking out to next week in the Federal Reserve, and I think most people we spoke to, when we asked them about the summary of economic projections, are they going to change from December? The answer was no. Got a little bit more information now. Is there a chance they change next week from December?
Well, there's a chance that we heard some of them talking in between the meetings about the possibility that they might not cut rates this year. Raphael Bostic, for example, Neil Kashkari talked about that. So it is possible they could move their dots. We're assuming their dots were in the 2 cut range before. So if they look at this data and think this is going to persist, and you're going to have to take it apart to really know whether it is going to persist. The portfolio management thing that we care about for the PCE looks like it was up just 0.2% after 5.9% in January. So it wasn't the stock market's fault this time. Insurance, health and medical insurance, though, up 1.4% after falling 1.1%. Now, this is probably a catch-up to the turn of the year and when insurance companies raise their rates. So we're probably seeing a little bit there. But those 2 areas are things that are going to be something the Fed is watching.
To put a bow on all of this, what we're seeing in initial jobless claims and continuing claims, people can get a job and they're not getting laid off in a way where they've got to file for claims, right? It doesn't seem like that's a real issue. On the PPI side, can we say that the narrative there is we are now seeing goods reinflation in a way that a lot of people didn't want to see?
That's a good way to put it. You didn't say in a way that people didn't expect. It's been expected that we would see goods deflation sort of slow and end because trees don't grow to the sky or fall into the ground the same way. So at this point, it looks like maybe that's where we are. Now, in terms of jobs, what you would expect from jobs is that people spend money because they have employment. And really, it doesn't look all that bad here. While we saw just a 0.6 rise in retail sales overall, a lot of that was held down by gasoline stations. Gasoline prices were up only 0.9%. That wasn't what people had expected. Clothing store sales fell by 0.5%. Department store sales fell by 0.2%. But motor vehicles were up 1.6%. Electronics and appliance stores up 1.5%. So some categories did fine. Some categories not so good. The food services and drinking places we always look at, they were up just 0.4%. So it does show that people are still going out It's the only services number in the retail sales.
That's the TK indicator.
That's
as
the
you know.
TK indicator,
That's why
yes.
just traditionally on this programme, we've always looked at that. That's retail sales. I want to talk about jobless claims briefly. If you are just joining us, big downside surprise, 209. 209, and the previous week revised to 210, so way better than expected there across the board. The estimate was 218. We're actually looking for that to climb higher. Didn't happen. 209 on jobless claims this morning, and PPI hotter than expected. And Lisa Wright to point out, yes, there is lots of conflicting data at the moment, and this morning there's something for everyone, but ultimately the trend this week when it comes to the read on inflation, upside surprise. Upside surprise. And what you've seen in the bond market off the back of that, 4 days of yields climbing on a 2-year. Check out bonds right now. We can look at the 2-year together. Starting life this week in the 440s, now at about 464. Yields up by, let's call it half a basis point, up by 2 basis points on a 10-year, 420.75. In foreign exchange, the euro a little weaker, dollar stronger, 109.37. In equities, the S&P 500 positive by about 0.2%. Lisa, I have to say, had the initial move, and rather like what we saw on CPI, the initial move faded after a few minutes or so. I often say when the data comes out, let's see if it sticks. Let's see if it sticks. And a lot of the bad stuff just hasn't stuck at all.
Well, what is the bad stuff here? Is it the higher inflation, or is it the retail sales that people are hooking into and saying, actually, maybe there is weakness here? As you said, people see the narrative they want to believe. And the problem is that we haven't gotten truly conclusive data to really confirm a lasting trend with any of it. I will say, though, it's hard to ignore the upside surprises to inflation.
Jay Bryson, Chief Economist at Wells Fargo, joins us now for more. Hey, Jay, let's get into that. CPI upside surprise. PPI upside surprise. Going into next week, Jay, what kind of changes, if any, would you expect from the outlook from this Federal Reserve?
So, John, in terms of the macroeconomic projections of the Fed, I'm not expecting a lot in the summary of economic projections there. You know, you were noting earlier in terms of the dots. I mean, it would only take 2 members to switch from 3 rate cuts to 2. So the median could potentially change next week. And I guess, you know, if there's an upside risk here to the projections for next week, it would be to a little bit higher inflation and, you know, maybe the median dots shifting up as well. But, you know, in general, I wouldn't expect huge changes from the statement next week or from what Chair Powell says in his press conference relative to what they've been saying recently.
Have you changed your view, though, Jay, about the idea of how sticky inflation is and how long it's going to remain high in the face of a labor market that really doesn't show signs of cracking?
So to answer your first question there, Lisa, yeah, we have pushed back we initially thought the first rate cut would come in May. I mean, I think that's kind of off the table, more or less, at this point. We've pushed that back to June. And, you know, I guess what I would say is I think the risk to our forecast would be skewed towards later. That is, I would say the probability of July is higher than you know, May at this point. But in general, you know, we really haven't really changed our views all that much. And in terms of the labor market, I mean, so we saw these initial jobless claims today. Now, I wouldn't make a lot of just 1 week sort of data. If you step back and you take a look at it, what we are seeing in terms of the labor market is the quits rate has coming down really quickly. You know, the job openings is also coming down as well. And then if you look at the unemployment rate, that is starting to move higher here. And, you know, obviously it's at a very, very low level still. So what we are seeing is we're seeing some softening in the labor market. It's not like it's falling apart or anything, but that should, as we go forward, continue to bring the employment cost index lower.
How long are we going to remain in this limbo? We're trying to understand what the trend is, and you've got people who are saying the sky is falling, inflation's reaccelerating, take a look at 3-month and 6-month trailing averages, and other people say, cut it out, it's on a downward trend, you're being overdramatic. How long before we have a conclusive decision on those two narratives?
You know, at least I wish I could answer that question. I just think we're going to be in this choppiness though for a while here, and so I think we're just going to have to live with that. And I think what you need to do is, you know, we need to step back and we need to say, okay, we all look at this data today, and what does this mean for the Fed next week? What does this mean for the Fed in May? You know, the Fed doesn't at this point. It doesn't really know either. It's taking these data in its entirety as they come in, and it'll make its decisions as we go forward. And unfortunately, I think we're going to be in this choppiness, you know, for a while.
So right now, as we take a look at the way that the market's responding, we see stocks really shrugging off pretty much everything. We see bonds reacting, but in a controlled sense. What is the threshold for financial conditions and the easing of financial conditions to create a problem for the Federal Reserve?
So, if we continue to trend in this direction, stock prices going higher, if we continue to see bond spreads coming in financial conditions, and that juices the economy even more, I mean, that would be, I guess, somewhat of a problem for the Fed in terms of its easing path going forward. Now, they're not targeting stock prices. They're not targeting bond spreads. I mean, what they are looking at is the effects of these financial conditions on the overall market or the overall economy in general. People make a big deal out of stock prices. It does have a wealth effect on people, but those wealth effects tend to be pretty small. So the point here is you need to have a lot of financial conditions loosening here for it to really start to have an effect on the Fed's decisions going forward. And I don't think we're quite at that point just yet.
When it comes to Jay Powell, he continuously says at some point this year we'll be cutting. Does that change to later this year? Does this timeline just get pushed back?
I think it does, Lisa. Because what we're seeing is, yes, the inflation rate is trending lower. Now, it's not coming down as much as I guess people would like it to be. But what's happening is that inflation rate continues to come down, and the Fed remaining on hold. The real Fed funds rate is passively going higher, and that's acting then as a passive tightening on the overall economy. And so, in some sense, they need to be cutting rates. Maybe not in May, maybe not in June or July, but they probably need to be cutting rates later this year, or you're going to have a passive tightening of monetary policy, which then could potentially slow things a lot more than people are expecting right now.
Hey, Jay, I appreciate your views, your opinion, your reaction to this morning. Thank you, sir. Jay Bryson there of Wells Fargo. I get it. It's part of the job. If you're in that seat, you've got to make a call on where the Fed's going to cut. Totally understand. June just feels meaningless to me. It feels really stale. The answer over the last few months has just been, the correct answer has just been later. Later, much later than you thought. It was March, it was then May, it was then June. And based on the data we've had so far, if you're looking to gain confidence from every single data point going into a Fed decision, how can you argue they've gained any based on what we've seen over the last 2 months? In fact, I would argue they've lost some, or at least they should have, based on the threshold they set for us at the start of the year.
I would agree. I am getting some messages from people saying, actually, the retail sales show real weakness. The issue is it hasn't been conclusive. The confidence issue, if they really are looking for confidence, no one who we talk to feels particularly confident about anything right now. There isn't a consensus. We're in this morass of confusion as we emerge from the post-pandemic reality into something else. We don't know what the something else is, and neither do they. And we take a look at this. How can you say with definitive kind of assurance we're on the right path?
Retail sales screams weakness, jobless claims scream strength, and PPI just says sticky. Upside surprise all week. I want to get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. SpaceX is set to take another step forward in its Starship program. The launch window for the third major test flight opened at 8 a.m. The target for liftoff is currently aiming for 9:25 Eastern. Starship is the largest and most powerful rocket ever developed and has an ultimate goal of taking humans to Mars. The last two tests ended in explosions, with this launch hoping to approach orbit. Treasury Secretary Janet Yellen says it's, quote, unlikely that market interest rates will return to pre-pandemic levels. The COVID pandemic triggered a wave of inflation and higher yields. 10-year yields averaged 2.39% in the decade through 2019. Last October, it spiked above 5% after the Fed raised rates aggressively to combat inflation. Rents in Manhattan rose during a busy February for leasing, with median rent coming in at just over $4,200. That's up 3.3% from a year ago. Overall, the number of new leases signed in February in Manhattan were up nearly 8% from last year. Rents typically drop during the winter months, but apartment prices are not letting up. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, Tesla, the growth company with no growth. A fantastic note in the last 24 hours from Colin Langan, the Wells Fargo analyst, joins this program next as this stock tries to bounce from yesterday's losses. Stocks on the S&P 500 still doing okay, up 0.25% off the back of another upside surprise on inflation in this country. It was CPI earlier this week, PPI a little bit earlier this morning, up another 2 basis points on a 10-year, 420.95. Under surveillance this morning, the growth company with no growth.
There's a lot to look forward to in 2024.
Tesla is currently between two major growth waves. We're focused on making sure that our next growth wave, driven by next-gen vehicle, energy storage, full self-driving and other projects, is executed as well as possible.
It's the latest. Tesla under pressure as a growing number of firms sound the alarm on demand. Wells Fargo analyst Colin Langan cutting the stock to underweight with a 125 price target, writing this: "We expect volumes to be flat in 24, down in 25. In the wake of price cuts, are lower lease residuals, disgruntled customers, and the possible loss of the luxury brand premium." Colin joins us now for more. Colin, your title, a growth company with no growth. Easy question. How do you value a growth company with no growth?
I mean, we usually use a DCF. You know, you have to look at the long term, right? So, and then you look at the earnings in the out years as well. So we look at a traditional DCF valuation, looking at the long-term growth prospects, and then we also try to normalize it, what you're pricing in. And even on our price target, I still think you're pricing in 10 million vehicles in 10 years. Long way out, but it's still quite a big number from where we are today.
You've got no growth this year, negative volume growth next year, growth the year after?
I have about 10%, a little over 10% growth in the year after. That is supposed to be when Model 2 hits. And to be honest, there's probably risk to that because we'll see how, we'll see what the potential Model 2 is. They're using what's called unboxed production, which has actually never been done before. So it's high execution risk to bring that to market.
Is this a Tesla problem or is this an electric vehicle market problem that Tesla is catching up to?
I mean, what I'm talking about is really more of a Tesla problem, to be honest. I mean, I'm pretty cautious on the auto industry in general right now. I have sells on all the Detroit 3 that I cover. But I think you're talking about a product that's a bit old. We're seeing customers just not interested in. And what we found in our report, and one of our real top concerns why we drove the downgrade, is that the impact of the price cuts is having a smaller impact on volume. If you go first half to second half, volume went up just 3%, cut price 5%. And the pricing cuts are painful. It costs almost $7,000 in gross profit per unit lost since they started these cuts. And then, as you mentioned in the intro, you have risk to the brand. You have risk to residual values too, and that's going to cause those disgruntled customers when you come back and your vehicle's worth less. So there's been a lot of pain to do these price cuts, a lot of profit losses, and we're not actually seeing the volume. And that's why I feel like they're going to have to make a trade-off at some point and just sort of capitulate that they can't really grow deliveries with price cuts.
So are you saying that sort of the discussion point around the fact that China is really driving the weakness in Tesla might be overstated, that there might be more at play even domestically for the company in your view?
Well, we're seeing weakness around the world, to be honest. I mean, U.S. actually, if you look at industry data, and Tesla doesn't give regional specifically, but since Q2, it's sort of peaked and softened. So, and that's with all these price cuts, right? So, we've seen weakness in the U.S. I mean, the product is, is it 7 years old now for the Model 3, so it's not fresh and new. We're definitely seeing in China, they're actually flat, but they're flat in a market, at least since Q2 talking about, flat in a market that has been growing, so they're actually losing market share there. And I do think longer term, the threat from China EV companies is very, very real. We did 6 teardowns over the last 2 years. The BYD teardown was pretty phenomenal in how it was engineered. I think they're a real formidable threat when you look on the global stage.
If you're not seeing the volumes with the price cuts, do you think the price cuts were a mistake?
Hindsight's 20/20. I kind of do. I think if you're covering the auto industry for almost 20 years, there's not many places you make money. You make money in luxury and full-size pickups. That's probably half of the global profit pool today. Honestly, historically, it's probably almost all the global profit pool. Right now, we have record pricing that's probably not sustainable. So one of my concerns is also, as we wait for these 2 years, you get Model 2. What I think we're forgetting is that the prior launches were into the luxury market, where there is more room to make margin. Now we're launching into a compact SUV. Compact vehicles are notoriously limited profit. A lot of people even think of them as starter vehicles just to get people into your brand. So very narrow margin starting point and an e-powertrain on top of that. So you're probably starting in the red. So when they're revolutionizing with unboxed production, they actually need that savings to kind of get there. And the other risk with unboxed is the savings really will only be there if you sell in volume, because the savings are supposed to be, I could get more out of my plant. So if the vehicle isn't very successful in terms of volumes, then you're actually not getting any of the cost savings and the leverage that you get on labor and depreciation.
You don't like the others either. You've mentioned that, the Detroit 3. I want to talk about that briefly. Adam Jonas over at Morgan Stanley, a bit more constructive on this, said this yesterday: lower spending levels, increased cash returns, higher for longer internal combustion engine, uncrowded position. We believe the narrative is changing on global autos. Why do you see it differently?
I think what people are missing, and probably he's missing, is EVs, right? So even though EVs are softening, we're seeing consumers not interested in them, they still need to sell these vehicles, right? And so, because there's regulatory targets. And even if, let's say, a Republican or Trump wins, it's going to take him time to change the current rules. And the rules are extremely aggressive. So we're probably at least stuck through 2026 targets, which for the Detroit 3, you need about 10%. You're at 3% on average today. So they're going to have to sell more of those. And on top of it, I think people are getting a little numb to the fact that pricing has been very strong. I think pricing could come down. It's kind of well known. And I think that's going to be a pain as you go through the year.
So GM just can't flick the switch and lean into hybrids and become Toyota overnight. Is that basically what you're saying? Is that too difficult?
I think it's extremely difficult, and that's one of the concerns I have for GM is that the bet of going all in on EVs. I think they've already said they're going to do a PHEV, so I think it's going to take them time to bring that to market, whereas, Ford and Stellantis have actually, developed hybrids, and so they could ramp those strategies now.
Colin, this was great. Fantastic to catch up. Really interesting note. Appreciate it. Colin Langan there of Wells Fargo. The growth company, Bramo, with no growth and maybe no growth for the next couple of years.
Which is the reason why you got it booted out of the Magnificent Seven.
Yeah.
And that's basically what we've seen so far this year. I do want to just note quickly, I was going through some of the retail sales data, and this actually is a component of it, auto sales and some of the issues there. There is just a more discerning demand, and I wonder how much that's part of it. People are being much more careful with how they buy and what they buy and how much they spend.
You can see where the growth is. This is not my opinion on a manufacturer, the trend, the ultimate destination. It's just where we are right now. The sweet spot, hybrids. Look at Toyota stock, just absolutely flying over the last 12 months. That's where the market is now.
And the companies who are able to track the reality of demand are going to be more successful, right? I mean, is it basically a tell on how they can get ahead of where consumers are going to be, more than where the market will be, say, in 5 years?
Where the market is right now, shrugging off big time the numbers that we got just moments ago on the S&P 500. Equity futures here, positive by 0.2%, even with another hot inflation print. PPI higher than expected. Tomorrow, John Stolfus at Oppenheimer, Alcelinos of RBC, Sarah Hun of Alpine Saxon Woods, and Ian Lingen of BMO Capital Markets.